it ultimately comes down to whether or not we see a unexpectedly higher CPI number.
If inflation suddenly starts to reverse, that could really cause them to pause at the December meeting.
If we get a stronger reading, then what you would see them do, I think, is still cut in December, but say, we might be at that point where we would slow the pace of cuts.
We think that there is going to be a bit of upside surprise in these numbers.
Maybe we are either moving sideways or actually having a risk of inflation beginning to move higher.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. This is the day you have been waiting for, 2 hours and 30 minutes until the most important data point of the week. A key read on U.S. consumer inflation before next week's Fed meeting. Futures edging up after 2 straight days of losses, which is the first time we've seen that in almost a month. John Ferro is off this week. Danny Berger joining Anne-Marie and myself around the table as we look through what potentially could be the surprise right now, Danny. Not necessarily setting up for some sort of big CPI-related shock, but just a hint of concern with yields creeping up for 3 straight days, which is the longest streak in almost a month.
And I wonder what reverses that, what you need to get bonds rallying. Presumably, you need a big surprise to the downside, because 0.3%, what we're expecting, still shouldn't give the Fed any comfort. And Lisa, as I know you know very well, 4.5 hours after the CPI print, we're going to have to take in a long bond auction.
Well, and that's exactly correct. Thank you. You're
welcome.
Speaking to the choir. We're going to be dealing with 10-year notes being sold at a time where there's a real existential question about how much inflationary pressure is in the works. And Anne-Marie, one of the key questions is the geopolitics of the moment. We've been talking about Syria, but there's a new kink on top of it. You were reporting overnight about potential measures that the Biden administration, yes, Biden is still president, might take to try to stave off some of those geopolitical threats.
Yeah, as they're looking into this potential glut that we see and a softness in the oil market right now, potentially what we could get is the Biden administration coming out and going after portions of Russian crude that they will sanction outright. So this is not an oil price cap. Think of the way the United States sanctions parts of Iranian crude, those exports. That could potentially be a risk premium you'd see on the oil market. We're still waiting, but the timeline is they have, 6 weeks to do this. The timeline is very short for them to get this done, but the market is saying potentially now is the only time, and it's after the election, that they'd be able to make such a sweeping move.
Which is the reason why, and I actually think it's fascinating and great reporting at a time where a lot of people are discounting the prospect of inflation and pricing in this sort of soft landing nirvana, how vulnerable the market is to a shock, whether it's coming from oil or whether it's coming from something else. And that, I think, is the reason why it's so important.
Well, Jim Reed over at Deutsche Bank in his note this morning says if inflation does make a comeback in 2025 and 2026, it may be centered around tax cuts and tariffs. So today's number is well before any of that might happen. There's so many unknowns that we can see in 2025.
Well, and this is a reason why I think it's notable that there have been 2 straight days of losses on U.S. equities. Danny, it really highlights the vulnerability at a time when so much euphoria has been priced in and you've brought forward a lot of the positivity without the negativity.
I was going to say all this fear might be simmering in the background, and then you get something like that small business optimism survey from yesterday, which sees the biggest jump since the thing started tracking in 1986. And it was remarkable to look at what CEOs said, basically saying that we're going to have scaled back regulations, high standard trade agreements, and avoiding overly broad tariffs. We're pricing in the good stuff and overlooking the bad stuff.
Well, coming up this hour, and right now we're looking at a market that's trying to claw back some of the losses from the past couple of days. Coming up, Marvin Lowe of State Street with the S&P 500 on that 2-day losing streak. Justin Dercole of ISO-Mts Capital Management ahead of key inflation data. And Sheila Kahyaoglu of Jefferies on our 2025 outlook for the airlines. People just keep traveling. We begin this hour with stocks taking a breather, but trying to inch higher ahead of one of the Fed's last data points before it meets next week. U.S. CPI at 8:30 Eastern. Marvin Lowe of State Street writing this: the Fed will continue to normalize rates, cutting next week, even as it likely further debates the neutral rate. The Fed outlook will remain below market expectations of terminal, even as it raises its long-term dot again. The market will just agree to disagree for the time being. Marvin joins us now. Right now, the market is disagreeing, sort of. At the same time, you are seeing this complacency around the idea that overall the U.S. is on a disinflationary trend. How vulnerable is this market to an upside surprise in inflation?
You know what? I don't expect an upside surprise to the degree that's going to kind of derail, if you will, the story that the Fed has to continue to normalize. They continue to think that we're restricted and there's room to get there. but we're getting there really, really fast. Whether or not we look at it from the market perspective, the market only thinks the Fed's going to get to about 3 3/4 next year. And then what? It's a very different environment than when we were talking about interest rates that were neutral at 2.5, and a 10-year that could continue on in a 3% world. That doesn't exist anymore, and that vulnerability and whether or not we're really pricing it, let's say after we get a lot more clarity on this administration, is certainly a risk. But right now the market is very happy with the fact that soft landing is still the story. Things are cooling in the right ways, and for the moment, U.S. exceptionalism is a story that's really, really hard to push back on.
We're going to get to the whole question of what the Trump administration is actually going to do. But even before then, there's a lot of disagreement about where we are right now. And that's one thing that I am really struck by, where people disagree fundamentally on how much inflationary momentum there is in the underlying economy without the tariffs, without some of the potential tax cuts, et cetera. What do you make of that? Where do you stand on that debate?
Agreed. I mean, it definitely is looking at the best parts of the story. On any trading desk, once CPI comes, you start cutting it up. And you listen to the Fed, and they used to cut it up in a way that they don't now. Supercore, which is kind of the services less housing, something that was so important, has been rising over the last couple of months. We don't hear them talk about it anymore. It used to be the number, if you will. There is enough disinflation on the good side of things to keep the story going, if you will. Shorter-term measures don't look as good. Spot threes per month, which is what we're talking about here, is nowhere near a 2% kind of target number. But overall, you do have those bigger components that are still going in the right direction. But again, whether or not we stop at 3 3/4, 4 is a big question that potentially is not as attractive to risk as this broader disinflation theme that the markets grabbed hold of.
Well, because the Fed's also grabbed hold of that theme too, to be fair. The recent speeches that we've heard from them is saying we're cutting not because we're worried about the labor market, as they had said in the past, but because disinflation is taking hold. Does that mean, though, that if we don't know where neutral is going to be, we don't know whether we're restrictive enough, that they could end up cutting too much, especially as animal spirits are getting reawakened by what kind of policy we might see in 2025? I
mean, it's always a risk, right? Just really the interpretation of what tariffs are. Are they just temporary inflationary? And is there just a temporary inflation component to it, the way kind of the Teal book that everyone talks about from 2018 says? Or is there a bigger downward growth aspect associated with that? All of that's in the mix right now. And we're going into this administration with a very different economic environment cycle than we had back in 2017, 2018. But the market is assuming, as it has throughout this entire pandemic cycle, that everything looks the exact same. And that has not proven to be true.
What do you think is the biggest disconnect in that regard, that we're assuming will be the same, that will not be the same?
Yeah, you know what? I think to be honest, the immigration component is the biggest unknown and really the biggest concern that I have. Just given where the labor market is, given the fact that foreign entrance into our labor market is critical, and we don't have economic models that really understand what the type of deportation policy this administration is talking about. It's incredibly stagflationary, and that is ultimately one of the worst kind of environments for a central bank and for an economy to deal with. On one instance, they should increase rates because you've got wage pressure as a result of that. On the other side, you've got the growth concerns, and that's all in the mix right now.
When it comes to this idea of sequencing of next year, what is your base case? And we might actually get some insight. Speaker Johnson yesterday was saying he's going to go to this Army-Navy game with President-elect Trump over the weekend, and that's going to be what they discuss on the sidelines.
I mean, I think 2025 is very complex from a fiscal perspective. I think the tax cuts, however they approach it, whether it's codification, whether it's a reconciliation, I think all the other promises, and I guess maybe we should all try to get our wages measured in tips. They're talking about all of that stuff, if you will, plus the debt ceiling is a bigger, and tariffs as part of that, obviously, is a bigger pool of decisions that they've got to get through next year. For me, really understanding how they approach the whole fiscal side of things and whether or not we start to see tariffs as a means to an end or an end goal itself in terms of reordering trade will give you a sense, are they looking to cut deals? Because a lot of the comfort you get in tariffs is that it will look the way it did the first time. Deals were cut. So we don't import from here, but we could produce someplace else where a deal was cut. USMCA is going to be key to that. I don't think it was just random that Mexico and Canada were some of the first salvos.
But that's not up for renegotiation until 2026. So are tariffs...
My understanding is that parties can exit if they wanted to. So I would expect the administration to start saying that, we're going to start to relook this and rework this. And if they cut deals as part of kind of this 2026 deadline, or maybe even earlier, we'll get a sense as an administration that's looking to cut deals the way they hadn't in the past.
In order to keep gains in the stock market, do they potentially, if they're going to go with tariffs, negotiating or blanket, do they need to do that alongside the good stuff?
They do. Yeah. It's first 100 days, first 6 months, it's going to be action-packed in terms of a market that has, again, as you mentioned, Lisa, grabbed onto all the good stuff. It needs confirmation of the view that it has.
In the meantime, what we do see is one trade that continues, and that is the dollar being ascendant, and even more so today. And what we have is a twofold kind of turbocharging of it. On one hand, you've got a report out of Reuters talking about China maybe having a weak yuan policy at the same time that we've been reporting that the Bank of Japan doesn't see that big of a downside when it comes to holding off on a rate hike over at the Bank of Japan. So you put this and you start to wonder, how much do other countries use the strong dollar to either juice their imports, potentially help their economies, and how much, to the extent that it dampens inflation in the U.S., does it also dampen growth on some sort of level? How strong is too strong?
That's a big question. Ultimately, a stronger dollar with the role that the U.S. dollar has as a reserve currency causes a lot of problems. But what level that is ultimately anyone's guess. 110 on the DXY, from a DXY perspective, I think really starts to raise some eyebrows because it will get through levels that it hasn't been able to get through before. But yeah, it's hard to pick through a reason not to really like the dollar. It's the cleanest kind of either risk concern, tariff concern, administrative policy asset class that gets you where you want to get to.
Right now, you're looking at DXY at 106.74. Marvin Lowe of State Street, thank you so much. Really appreciate it. And Danny, to me, when I was looking at some of these stories about whether it's China or whether it's Bank of Japan, how much are people changing their view on what they think of a strong dollar as maybe we can use that?
And I also think it just underscores, this is something Torsten Slok has been writing about, that Trump's desire for a weaker dollar and some sort of plaza accord, it's not going to happen. These countries want weaker currencies versus the dollar. And even not mentioned within this is Europe. We're going to get an ECB decision tomorrow. Europe desperately needs a weaker euro in order to juice some type of economic growth.
Are we talking about a 50 basis point rate cut? That's one question being circulated, and every time I bring it up, people say, not a chance. Right now, let's get you a story, update on story elsewhere. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. The suspect in the murder of the United Health Group CEO is being held without bail in Pennsylvania after fighting extradition to New York. Authorities in New York have gathered evidence against Luigi Mangione, including surveillance video, autopsy results, and written admissions. They're seeking his return to New York to face second-degree murder and weapons charges. He's due back in court in Pennsylvania on December 23rd, unless he's extradited first. The Biden administration is weighing harsher sanctions against Russia's lucrative oil trade just weeks before Donald Trump returns to the White House. Our own Anne-Marie and others here at Bloomberg are reporting Biden's team may target some Russian oil exports as fears ease over a spike in energy costs. The outgoing administration has also moved to ramp up military and financial support to Ukraine as it prepares to depart. And California authorities say the Franklin fire near Malibu has spread to at least 3,000 acres. The fire is forcing the evacuations of at least 20,000 people while shutting down a stretch of the Pacific Coast Highway. At least 1,500 firefighters are racing to fight the blaze, which is being fueled by dry conditions and Santa Ana winds. The fire is 0% contained as of late Tuesday, with no fatalities. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira, and we do hope that it comes under control even more so in the next few hours. Up next, blocking the steel deal.
U.S. Steel has been an iconic American company for more than a century, and it should remain a totally American company.
I would not let U.S. steel be sold to Japanese.
That conversation coming up next. This is Bloomberg Surveillance. Two straight days of losses, and even though those losses don't add up to even a % decline, what you're looking at right now is a market that has not seen two consecutive down days for almost a month. Right now, trying to claw back some of that. S&P futures up about 0.1%. Dollar ascendant with a whole host of regions from China to Japan seeming more amenable to the idea of a weaker currency, and yields just rising a touch ahead of CPI. Under surveillance this morning, blocking the steel deal.
U.S. Steel has been an iconic American company for more than a century, and it should remain a totally American company.
I would not let U.S. steel be sold to Japanese, by the way. I would stop it if it hasn't been completed by the time I'm president.
Here's the latest. President Biden is planning to formally block the $14 billion sale of U.S. steel to Nippon Steel. Sources telling us here at Bloomberg that Biden plans to cite national security concerns when the deal is referred back to him later this month. Bloomberg's Josh Wingrove joins us now. Josh, a question of just how much of a surprise this is, given the fact that what we just heard there was both Biden and Trump talking about how they plan to block this deal.
Yeah, in some ways, this is a story of consistency across both parties. Of course, back in September, there was a lot of coverage around this when the deadline was approaching, and then it was essentially punted. They did what's called a pull and a refile. It's a maneuver to buy time and push things past the election. Well, since then, a lot of people have been watching this wondering if Joe Biden was going to change his mind. Election's over, maybe the circumstances have changed. And meanwhile, Governor Shapiro, of course, a Democrat of Pennsylvania, is, at least according to Nippon Steel, kind of working behind the scenes to get the parties to the table to see if the union and Nippon Steel, the Japanese buyer, can come to some sort of agreement. It just doesn't seem like the union has gotten there yet, and our reporting is that the president's mind hasn't changed either. We're also reporting that another delay isn't expected. In other words, this can is not going to get kicked further down the road to President-elect Trump, as you heard him say, if it's not resolved when I'm in office. So we think that is not going to be the case. We are also being told that litigation is likely here. Whether that works or not, who knows? But this thing has been sort of bouncing along for almost a year now. It was late December last year when it was announced. And of course, this is an unusual CFIUS case to become a bit of a lightning rod. These reviews are normally aimed at China.
Well, also, Republican lawmakers last month are telling the Biden administration that they need to keep all the documents and the paperwork related to this case because they think CFIUS has been used for political interests, not national security concerns. Do they have a point?
Yeah, they think Biden has made up his mind here, or at least they're hinting to think that already, sort of absent the process. If that might be true. It seems also true that President-elect Trump has made up his mind here. So regardless of whose thumb there's going to be allegations, I think, of one thumb or another being on the scale. So, the CFIUS process here is secretive and includes ultimately a panel of advisors. These are many of them include, of course, members of Biden's cabinet. So the question is sort of what they will do in this process. The White House saying on the record for our story that President Biden believes it is, quote, vital that U.S. steel remain both domestically owned and run. That sort of signals that any solution with, some sort of proxy board, they don't seem to be signaling an openness to that. They're also saying that the CFIUS process is ongoing. And what we can infer from that is that the file has not yet landed on the president's desk. The deadline for that, we're told, is December 22nd or 23rd, thereabouts. After that, he'd have a couple of weeks to announce whatever decision he makes.
Josh, we also heard from Trump yesterday vowing to speed up regulatory approvals for investors spending $1 billion or more in the United States. At the same time, he's saying, and has been on the record, that he would block the Nippon Steel, U.S. Steel deal. So how does the Trump campaign transition team square that?
They haven't. I don't know what to say. Yeah, when that landed, it was just like, oh, okay, I guess, except in certain cases for it. So he's pledging that. That's, regulatory rollbacks have been, in fairness, a bipartisan issue for some time. So cutting red tape to expedite approvals, things like infrastructure projects. Also, energy projects will be a big one for that. So in some ways, not surprising to hear Trump, call for that. But yeah, what is clear is that as is always the case with Trump, there are sort of, top line rules, and then everything is sort of a case by case basis. At least as of now, his stated position, most recently, including just last week, was that he will block this deal if it does indeed come to him. Now, the mechanics of that, I should say, again, our sources are saying that won't be the case. I don't understand how it could happen. The mechanics would have to be a little tricky. The companies would probably have to agree to pull and refile, even if the CFIUS panel would. So it's not clear to me, and the people we're talking to, whether an extension would even be feasible if there is appetite to it, and there's not much public interest of appetite.
Josh, just on the point of, if companies investing $1 billion, they get expedited permits. It kind of reminds us of a time when Trump makes these posts that are quite sweeping in nature without many details, and it's left to his cabinet, to his advisors to put together the pieces of the actual legislation. Do we understand what something like this might actually look like in practice when, as you say, the DC for some time has been trying and failing to remove some of the red tape around these issues?
Yeah, we don't. And the reason you're enduring my sort of central casting hotel background situation here is that the reporters here in West Palm Beach who are covering the president, were sort of sitting around waiting for like a puff of white smoke from Mar-a-Lago for him to put sort of meat on the bone of some of this stuff. And it's sort of trickling out. We had a couple of announcements last night of ambassadors, for instance, the cabinet is already, and then came this True Social post about the regulatory plan, if you theme. I don't know, what we would call it, but they have not specified yet where it would be. But, they have the trifecta right now, or they're going to. So all these things, I think, are signaling as Republicans in Congress really start to get down to brass tacks of how they're going to sequence things, what legislative tools they're going to use, what is the priority, what is not. So if anything, I think this is a signal to House Republicans, Senate Republicans of one thing that he wants to be wrapped up in any sort of big package that moves quickly.
Well, the other announcement we got yesterday was Trump's pick of Andrew Ferguson to lead the FTC. Josh, how different of an FTC would we be grappling with versus that of a Khan one?
I think it's safe to say different. It's one of the advantages of this appointment is he can be there on day one because he's already on the FTC. Lina Khan is a folk hero for many of the Democratic Party, particularly progressive for her interventionist approaches. He's pledging to not follow the Khan model. It's interesting because Khan does have some sort of signals of support from certain parts of the populist, sort of, if you want to call it that wing of the Republican Party, including Senator J.D. Vance, who's sort of made more muted or less critical statements on her than other Republicans have. So I think there will be elements of the sort of antitrust populist agenda that overlap with both parties. But I think it's pretty clear right now that the Trump administration was not interested in continuing with Khan's approach, of course, because they could have just simply, explored keeping Khan. So now this is where we're going. But I would not expect Khan 2.0.
Josh Wingrove of Bloomberg, thank you so much, and good luck at the hotel in Mar-a-Lago. I'm glad that you brought up Andrew Ferguson, Danny, because right now we're looking at the potential for a rash of M&A. We've seen the announcements of a whole host of different mergers, whether it's Mondelez and Hershey's potentially. We've heard the rumors of that. We did just get Kroger and Albertsons being halted by a federal judge. You wonder how many of these companies are going to re-up some of these cases.
They very well might, but I think it's worth to remember that some of the ongoing cases, and Anne-Marie, you've talked about this, started in the Trump administration. Things like pursuing Google. So saying, okay, they might be reversed. We have this M&A euphoria coming. Goldman Sachs' CEO has been talking about it. I think there might be a moment next year where we kind of pause the brakes and say it might not be as great and sunny as we all expect it to be.
That's the thread between Trump 1.0, Lina Khan, and now Andrew Ferguson. It's going to be big tech. And that was one of the things that Trump highlighted when this announcement came out. Andrew has a proven record of standing up to big tech censorship. When it comes to things like handbags, groceries, maybe this FTC is going to allow it to go through.
This is going to be something we'll track for a while. Coming up, we're going to have a conversation with Justin Dercole of ISO-Mts Capital Management ahead of key U.S. inflation data. In the markets, you are seeing an effort to bounce back after 2 straight days of losses. This is Bloomberg Surveillance. hours until CPI, that key report before next week's Fed meeting. You've got futures trying to tick upward after 2 straight days of losses, led really by the NASDAQ, which has been outperforming really in the past couple of weeks, up about 0.25%, up about 1/10 on the S&P. Yields continuing their climb. This, to me, really stands out. There have been 3 straight days of at-the-close yields being higher, 2s, 10s, and 30s, Danny, at a time when people are wondering how much they might be underpricing the risk of inflation being a bit stickier.
This is the thing. We could get everything as expected, 0.3%. We say, great, it's as expected. The Fed's going to be cutting. That's what markets are pricing. And then I think we need to have a really serious conversation about inflation next year. As Anne-Marie pointed out, this number comes even before we understand what the Trump administration is going to do. This number comes as we're dealing with more bond auctions. Just today, even if it's in the all clear, there's some serious questions that need to be answered.
Especially at a time where there still is a massive geopolitical overhang. And Anne-Marie, I keep going back to this. There's a question of how much oil prices and gasoline prices could increase if some of the sanctions really go through with respect to what Biden is talking about on Russia currently.
Well, they're under discussion right now within the administration is a lot harsher sanctions than we've seen. And this really wouldn't be up for discussion ahead of the election or if prices in gasoline were higher right now. But they see this as a moment that it could be appetizing before they leave the White House to give Ukraine this final push. And this would be outright sanctioning portions of crude the same way the U.S. has sanctions on, say, Iran. On top of that, potentially also going after more of Russia's shadow fleet. This is something the UK and the European Union have also been doing.
We've got more on that in just a minute. Meanwhile, you do have a dollar that is ascendant at a time when you've got China and you have Japan making noise that maybe they are not as concerned about a strong dollar. Japanese yen falling yet again, 152 the dollar versus the yen, as the Bank of Japan seems to be amenable to the idea of waiting, that it isn't going to be that costly. And there are reports that China is going to maybe pursue a weak dollar policy. Under surveillance this morning, something that has the attention of every parent, every executive out there, Luigi Mangione, the man accused of killing health insurance executive Brian Thompson, is being held without bail in Pennsylvania. Mangione is fighting extradition to New York, where he faces second-degree murder and weapons charges. The move could delay his return for weeks. And in the meantime, everybody is glued to this story at a time of pretty significant implication, Danny.
It does. There was a CNN and Time story basically saying that the New York PD had a document saying that police are concerned that they're going to see this man as a martyr, an example to follow, and likely view him as a hero of sorts. I think the discourse around this has been extremely concerning because you see some of that bubbling up online. Nothing is justifiable for this type of violence. I think that's abundantly clear. But you have people online almost celebrating this. It's really concerning, and it's led to CVS, for example, has actually taken down the images of their CEOs on their websites. Corporate America is very fearful at this moment.
And corporate America, and we spoke about this, is starting to look at the security around their top executives. Which is so interesting about this case is that this investor conference day, there was a lot of security inside the building. No one was with that CEO as he was walking in.
Which is a reason why people are wondering what happened on multiple levels. Meanwhile, the Biden administration is weighing new sanctions on Russia oil, as we did hear Anne-Marie talking about before Trump returns to the White House. Sources telling Bloomberg details of the possible new measures are still being worked out, but the team is considering restrictions that might target some Russian oil exports. Anne-Marie, wonderful reporting. On a broader level, there is a question of what the Biden administration is trying to do ahead of its exit from the White House. And it goes with respect to potential sanctions, but it also goes beyond that.
So I think there's two things. It's the timeline. It's finally after the election where they can maybe go for some of these harsher measures that they would not think of before an election. And it's before an incoming Trump administration. So it would also put Trump in a rock and a hard place. Would he then come in and offer waivers to Russia? Probably not. And if oil prices are higher, that is also going to be concerning for him as he ran on the president that can tame inflation. What is so interesting about this is that we have seen incrementally the administration want to be harsher on Russia. They rolled out last month these sanctions on Gazprom Bank. This would be, though, for the first time ever, going after directly the crude that leaves Russia's shores. Not a price cap. They're not going to be able to basically trade it, but within a cap and a price that the U.S. and the West deem doable. This would be going after actual crude. So potentially this could be higher oil prices following an announcement if they come to that decision.
Watch this space. In the meantime, General Motors is getting out of the robotaxi business. The company is saying it will combine its two units, both of what we're seeing with respect to the Waymo and the Cruise, as well as potentially some of the technological teams associated with it, into a single effort focused on developing autonomous and advanced driver safety and technology. Danny, I'm trying to understand what the motivation could be here for this, especially at a time where we're seeing Tesla fly high.
I'd say on one side, you could say, okay, not surprising. They're already scaling back their EV. They're restructuring their business in China. They're going on a cost-cutting and saving operation. But on the other hand, I think you're completely right. The timing of this is odd, to the point where even TechCrunch was reporting today that employees were blindsided. They learned about this when everybody else did with the press release. You have a time where a lot of companies are racing to join this exclusive robo-taxi club. And let us not forget what this does to valuations. We've talked to how many people? I'd say the reason that Tesla should be bid up is because the future that this promises. This is GM missing out on a big chunk of that.
And to be clear, this is the Cruise self-driving car unit and its technical teams. Is there some sort of strategic advantage because Musk right now, Anne-Marie, has the ear of the president?
I mean, I think proximity to power is probably helpful, but if that means that potentially this can roll back regulation, then anyone that's in that space would likely be lifted up, not just Tesla and Elon Musk. What I think is interesting, what if actually the robo-taxi business does become profitable? Will they look back and say, maybe we should have stayed in that? Another interesting factoid, GM pulled the plug on their revolutionary attempt at a commercially viable electric vehicle in 2003. That was the same year Tesla was founded. So while, yes, maybe the cash flow helps right now, I wonder if hindsight is going to say maybe we should have stuck with it.
In the meantime, it is less than 2 hours to the latest read on consumer inflation. The key question in markets is whether traders are overestimating or underestimating the inflation forces in an economy still distorted by pandemic effects. Justin Dercole of ISO-Mts Capital Management joins us now. Justin, you have a contrarian view at a time where everyone is welcoming the disinflation that seems to be incoming. You think that there is a stickiness and a pervasiveness to this inflation that most people are not recognizing. Please explain.
Yeah, so I continue to believe that the right way to think about this is to look through the lens of what you've been hearing over the past several months. In this case, I would say the risk management cuts. Remember, that was the term that people were using as it relates to what the Fed should be doing in August of this year in anticipation of this unemployment rate increase that manifested itself because of largely due to immigration. My view is that the market right now, pundits, the sell side, et cetera, are to a degree fighting the last war. And I think Mike McKee has made mention of this. And what I mean by that is there is an unconscious bias going on as it relates to what is going to happen to inflation, born out of 10 years post-global financial crisis of low rates, low growth, and no inflation. And so what continues to happen is the natural behavioral response is impairing the ability to see what's actually happening. And what I believe is actually happening is that the disinflation, a big chunk of what we got was down to China's economy rolling over much harder than anyone anticipated, and a normalization of supply chains. Now that those two things are largely behind us, the other thing that really was what was born out of that was goods prices coming down. And what you'll see today in the CPI is goods prices are now inching back up. And when you talk offline to street sell-side economists, I think they're wary of the fact that when they look at the basket, when some things are getting better, it is entirely likely some things are getting worse. And let me just...
Well, hold on a second, Justin, before you keep going. There is this question on a broader level of just how offsides markets are. And this is about short term and this is about long term. Where do you see the markets most offsides?
So the biggest risk is this free float of Treasury coupon notes and bonds. So the longer dated part of the market. The reason that is the risk is look at the shape of the curve. Everybody's been waiting for a steepener, and I think that's entirely correct. But the risk is if you look at the amount of Treasury securities that are effectively available to be traded now as a percentage of GDP relative to 3 years ago, before this Fed started QT and before the massive deficit spending that has inflated the deficit and the debt, you now have this extreme risk. And that risk is exceptional volatility across really all asset classes. If the Treasury market is sort of the core basis upon which our financial markets are built, which it is, and then you say to yourself, okay, the uncertainty associated with rates and where nominal rates are, those two inputs feed vol. And the market is, now it's not universal anymore as it was this summer, by the way, which was mistaken, but I continue to sense this belief that we're going to go back to living in the post-global financial crisis environment.
Justin, what happens, though, at a time where that's occurring, yet around the world there is discontent in Europe, in Asia, governments facing issues, and it's led to this narrative that the reason we're still buying U.S. bonds is because there is nothing else.
Right. So Germany actually tried to avoid the sidestep the debt brake, and that's why they're going to have an election in the second quarter. Germany, I think, believes they're the growth engine of Europe. The fact that they're underperforming on a GDP basis, Spain and Italy suggests to me that they're going to do everything they possibly can to get that thrown back. And so I think the amount of spending is actually at risk of accelerating. And the answer to your question ultimately is the nearshoring deglobalization item. Think about what China said about NVIDIA yesterday, what their focus is. This is building, it's building, and the pieces keep coming together. I focus on banks as perhaps you remember, and the key point is the difference between the post-global financial crisis period and now, among other things, but one of the biggest is if the banks are the engine to the economy, they're the portal through which Fed policy flows. They had terrible capitalization after the financial crisis, as you know, and they were terribly unprofitable. And the opposite is the case now. So the other thing you can say is that the economy actually has a significant incremental support system.
Justin, I'm also curious because the other thing we have to contend with is just what happens next year, this big unknown. But even before that, we have vibes and animal spirits, small business optimism survey jumping the most since 1986. You look at CEO surveys, plans for hiring, plans for CapEx, plans for expected sales. All of them are up. At what point do vibes turn into an inflationary force?
Right. And so this goes back to what the Fed making the decisions they made late summer, early fall around these risk management cuts, I think was mistaken. I just do. I think that the answer to your question is that we now have 2 years of data that supports that the neutral rate is higher. And so you only know the neutral rate ex post, meaning after the fact. You look back and you say, what did inflation do and what did growth do relative to a policy rate, all else equal? And we're growing at over 3% using Atlanta Fed in the fourth quarter of this year. We grew at 3% in the third quarter. The policy rate's been above 4% for 2 years. So it's not debatable anymore. This is the nuance. This is and I am so sympathetic to people like Torsten Slok, who comes onto your program, does a great job, and this summer seemed like he was a total outlier. When is the future the present? That's what people need to ask themselves. That at what point do we accept GDP for what it is, as opposed to saying, okay, but it's going to roll over for these reasons. It doesn't make sense to me. I think the risk is getting higher and higher and higher. Credit spreads are at their tightest level since 1997.
Yeah,
we know what happened in 98.
Yeah, Justin, unfortunately, we've got to leave it there. Thank you so much. Justin Dercole of ISO-Mts Capital Management with a passionate explanation of why he sees this as currently the new normal and, frankly, an acceleration in inflation ahead. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. U.S. President-elect Donald Trump has picked Andrew Ferguson to chair the Federal Trade Commission. Trump says Ferguson has a proven record of standing up to big tech censorship and supporting freedom of speech. Ferguson, who is already one of the FTC's 5 commissioners, will replace Lena Khan, who during her tenure drew ire from Wall Street and Silicon Valley. Meanwhile, Eli Lilly is planning to start studies to see if its blockbuster weight loss drugs are also effective at controlling addictive behaviors. Eli Lilly CEO David Rick sat down with David Rubenstein yesterday at the Economic Club in Washington.
Next year, you'll see Lilly start large studies in alcohol abuse and nicotine use, even in drug abuse. We'll also begin studies in anti-inflammatory conditions, because you don't think of that with weight, but actually there is quite a strong signal in anti-inflammatory.
Ricks also addressed the imbalance in drug prices between the U.S. and other countries. He said patients abroad should be paying more for their medicines. And Apple's next smartwatch will be able to send texts via satellite. That means users will be able to send messages even when they're off the grid. According to sources, this is part of a number of upgrades to the smartwatch, including a long-awaited feature allowing users to check their blood pressure. Apple hopes this will entice hikers and health-conscious consumers to upgrade their devices. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira, so we can manage our step count anywhere we go, even the forest of Death Valley.
The whole point, I think, of going off the grid is so you can't be in touch with people and you can get away and calm down. So,
yeah. Well, clearly I haven't been to Death Valley if I'm talking about a forest there. Meanwhile, up next, supply chains weighing on travel.
What's really impacting on the industry is the supply chain problem. So although next year will be better financially, I think it would have been a lot better had we not faced all of these supply chain problems that have been going on now for some time.
That's coming up next. This is Bloomberg Surveillance. Markets with an optimistic tone this morning ahead of CPI, about 90 minutes away from that print. Under surveillance this morning, supply chains weighing on travel.
What's really impacting on the industry is the supply chain problems. So we're looking at 8% growth next year, but costs are being heavily impacted by the delays in getting new aircraft, keeping older aircraft in service. So it's quite a lot of moving parts. So although next year will be better financially, I think it would have been a lot better had we not faced all of these supply chain problems that have been going on now for some time.
Here's the latest. IATA expecting a record number of people to travel next year despite supply chain issues, putting pressure on the sector. Sheila Kahyaoglu of Jefferies writing passenger revenues are expected to expand in 2025. Supply chain continues to inhibit industry as deliveries fall short. Sheila joins us with more. And Sheila, is this basically shorthand for those tickets are going to cost you?
They will, and we're finally starting to see that. Not in mainline U.S. Domestically, ticket prices are still normal, but when you're going, across the Atlantic, I think you're seeing pricing really tight there. So it's actually driving some profitability improvement, and IATA's forecast is back to peak levels in terms of profitability margins that they're expecting.
Can you expand on that? Basically, how much of a premium can you imagine on flights based on restricted capacity over to Europe because a lot of these airlines have been unable to receive their Boeing airplanes?
That's the pitch from the airlines, and that's really why you're seeing such outperformance in the airline sector since September. For domestic ticket prices, we're seeing pretty neutral pricing in the second half, but internationally, we're seeing ticket prices up pretty significantly. They don't quantify those numbers, but margins for the network carriers are 20%, especially on the international side. So that's really helping drive double-digit profit margins for airlines, which we haven't seen in a while.
When it comes to supply chains, we might get some answers very early next year, whether it be Trump saying on day one he wants to start some of these tariff proposals, whether it be the strikes coming from the port workers that would also put some stress on air cargo. What sort of rates are we talking about? Is the peak going to be higher this time around?
Certainly not. So in terms of Boeing deliveries, Boeing and Airbus combined, we're forecasting about 1,250 deliveries for 2024. At the start of the year, that number was closer to 1,600. So our forecasting is terribly wrong, or the supply chain had an issue somewhere in there. I think it was the supply chain, the Boeing strike compiled on top of that. So if you think about IATA's global forecast for growth next year, it's 8% air travel. We estimate you need about 1,500 to 2,000 new airplanes a year to provide replacement and new growth demand. So we're at 1,250 this year. So we're going to continue to see the supply chain slowly ramp. We saw that a little bit yesterday with Boeing's deliveries, obviously 0 in October. In terms of production rates, 9 deliveries in November for the MAX. Those numbers should be in the 30s. So we're going to slowly see that rate of change, or quickly see that rate of change improve, and that's why investors have started to look at Boeing's equity.
With how these individual airlines deal with this, I was really struck by a Wall Street Journal story about JetBlue. Their turnaround plan basically cut costs by removing some of the various routes you have, but focus on the high end. Give people ultra luxurious lounges, expand first class. Do you think we'll be in an environment in 2025 where that is still the model, where that can still help someone like a JetBlue turn around?
It seems the premium offering is really where airlines are outperforming. So carriers like JetBlue are looking at Delta and United and seeing their profitability margins, which is mainly international travel, but trying to replicate that, whether that's JetBlue or Southwest in the US, adding more premium seats, adding extra legroom, and that extra legroom could be defined as 3 inches, which I don't know what kind of premium that warrants in terms of a ticket price. So, I think it's up to one to decide what they're willing to pay for the ticket. For me, on-time travel is the most important.
When you mentioned JetBlue, so I have to go here, the JetBlue Spirit merger that we saw collapse under the Biden administration, could we expect more consolidation in the airline world 2025, 2026 because of Trump?
That's what airline management teams are likely hoping for, but I also think, do we necessarily need that capacity? When you look at U.S. domestic capacity, we had 6 to 7% increases in the first half in terms of the number of planes taking off, and ticket prices were down mid-single digits. So there was somehow excess capacity. That's because everyone was going to the same area. You had travel going to Florida, or you had excess capacity and flights folks no longer wanted. So that's now being taken out of the system, and it's probably for the best, whether it's deregulation or not.
Sheila Kahyaoglu of Jefferies, thank you so much. And I have to say, if we're paying by inch, I think that I'm going to get really sad if we start saying, if you've got 2 extra inches, you got to pay what? 25, 50?
But they don't tell you. And now I'm kind of worried because I am someone, even though I have extremely short legs, I have paid up for extra leg room. And now I'm like, maybe I was only getting 3 inches and it was all in my head that it was somehow more roomy.
Every inch counts.
Well, honestly, I just wonder what's next. Premium access to the toilet? Are you going to end up paying for the oxygen? That's sort of my game changer. You start paying for the oxygen, that's game over. But let's move on. Coming up next, we've got Stuart Kaiser of Citigroup, Monica Guerra of Morgan Stanley, Republican Congressman French Hill, who's up to head the Financial Services Committee, and Dana Telsey of Telsey Advisory Group, as we await numbers from Macy's. Remember that was pushed back after an issue with some sort of malfeasance around shipping costs. Right now, you're seeing markets just turning ahead of that CPI print. From New York, this is Bloomberg.
The long-term potential and a lot of the excitement around AI is hard to deny.
Everybody's, getting bullish on the growth outlook, at least in the U.S.
We do want to embrace equities at this stage. The problem is that a lot is in the price.
Expectations are just very high in too many places.
In 12 months from now, we are in a higher place, but it may not be an easy ride to get there.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. 90 minutes until the key data point of the week, the last major inflation read ahead of next week's Fed meeting. John Farrow off this week. Danny Berger joining Anne-Marie and myself around the table. We're looking at futures on a broader level, which have been trying to bounce. But what you do see is a real question around just how resilient and how strong the consumer is at a time where there has been incredible divergence between the winners and the losers in the retail space. As we drumbeat toward the CPI print, Macy's comes out with their delayed earnings following a suspension earlier in the month. And the real question here is what went wrong? Macy's revising downward its full year earnings forecast, talking about the full year adjusted earnings per share of $2.25 to $2.50 versus a high of $2.90. Danny, on a larger scale, how much can they just blame a lone employee, and how much does this speak to the difficulty for the losers in the retail space at a tenuous time?
Well, let's be clear. They are blaming that employee. In this earnings report, they're saying, look, this is why we have to revise things. Shares down decidedly, though, with this idea that Macy's has other issues that it's struggling with. And maybe this is just an example of it, of credibility, of strategy that's lacking at the company. Macy's has an activist investor, multiple involved in it right now, wanting various things to happen, wanting them to spin off their luxury offerings, wanting them to spin out a real estate unit. But how much of all of this is just financial engineering versus a real strategy shift that needs to happen at Macy's?
In the meantime, this is something that we have seen consistently, which is the winners of any earnings season, particularly in the retail space, get celebrated, shares pop upward. When you have a disappointment, they are penalized and penalized significantly. You can see that with Macy's right now, down more than 8%. A real question here about how vulnerable consumers are to further bouts of inflation. In other words, how much they're pushing back against some of the price increases that we saw a couple of years ago, which is the reason why people have conviction that maybe this disinflationary trend could continue.
Right, and we've seen this theme in the retail space, this idea of you see a lot of consumers being more choiceful. But they're still going out and they are still spending. What I find interesting is look at the latest survey data, and it's almost flipped. And we heard John Authers talk about this when it comes to inflation, how political it is. All of a sudden, Republicans start to think the economy, inflation, we're in a good place. And it's Democrats that are saying, actually, we're not. So you really need to look at, I think, all of the data to really decipher what kind of consumer we're dealing with.
That's the reason why CPI is really important at a time where there's big disagreements between whether we are heating back up or on the precipice of something more significant. Danny, at this point, it feels like this is a market leveraged to good news, which is the reason why we have seen a couple days of stalling out as people worry maybe this stickiness is going to be present.
Right, because two things can be true at once. You can get inflation numbers coming in that confirm that the Fed will be cutting in December and still be worried that the path down to 2% is going to be a complicated one. 0.3%, what's expected. And if we get that, everybody is going to cheer and say, great, the Fed's going to cut. That's not exactly comforting figures. That's also not comforting figures ahead of an unknowingness and a fog around 2025.
Exactly. It's not a question necessarily of next week, but maybe in the year beyond. Coming up this hour, we've got Stuart Kaiser of Citi as markets await that CPI report. Monica Guerra of Morgan Stanley as Biden defends his record on the economy, and Congressman French Hill on President-elect Trump's plan to boost industry. We begin this hour with stocks higher as markets await CPI, key data point ahead of next week's Fed decision. Stuart Kaiser of Citigroup weighing in. If inflation matters, then it's probably bad news. CPI has been priced as a smaller event than payrolls and FOMC. That reflects the downward trend in inflation and recent FOMC confidence that process will continue. That backdrop means a downward surprise will be far less impactful than surprisingly strong inflation, which is something that we can see right now in markets and how they've been responding. Stuart joins us now. Thank you so much for being with us. How offsides do you think this market is and not necessarily pricing a significant move?
I mean, they're only off sides if the data comes in hot, I guess, right? maybe they end up wrong sides. Look, I think, at the last FOMC, even, Chair Powell was really trying to hammer home the fact that they think inflation is on a downward path, and that's going to allow them to kind of ease policy from a very restrictive point. Our economists are 25 basis points or a little bit below on core CPI. I think if you get a print like that, to Danny's point, equities are going to take that positively and kind of rally. To the upside, you would need a massive upside surprise in inflation, not only in the level, bit, I think, in the constitution of that print to really disrupt markets. And frankly, at this point, you might need multiple of those in a row to change the Fed stance at this point.
This is an important point, given the fact that some people are looking at a couple of hiccups in the past couple of days as evidence that people are increasingly concerned about inflation. You have the likes of Justin Dercole coming on and pounding the table saying this is a market that is fundamentally underpricing inflation. Are you saying that really this is a pretty clear-headed market that is looking at all the incoming components, and isn't that susceptible to an upside surprise unless it really kind of knocks your socks off?
I mean, you are susceptible here. I mean, the consensus is that we are on a downward inflation trend. The Fed believes we're in a downward inflation trend, and you're going to need, I think, something to kind of significant to disrupt that. The Fed does not seem worried about inflation being a little sticky above target, for instance. So, if that's your view of what the market's underpricing, I don't think the Fed's going to care about that. I don't think the markets are really going to care about that. Look, if you got a tariff impact, if you got things like that really created an inflation impulse, I think that's a separate discussion. But I think it's going to take a whole lot to take the Fed off their core view right now.
How do you gauge sentiment at this moment? Because some of the metrics like cyclicals outperforming defensive, insane flows into U.S. equity funds, but at the same time, cash holdings continue to go to an all-time record. Is this a euphoric market or something different?
I mean, I think sentiment's pretty good. I think ETFs, which you mentioned, is probably the thing that's really shifted over the course of the last couple of months post-election. Retail is really getting, I think, aggressively involved in U.S. markets. And look, that's an investor base that's probably a little less sensitive to the percentile rank of valuation or, the amount of EPS that's priced into next year. So, yeah, I think sentiment is very positive, but I think sentiment is positive for a reason. The economic growth has been surprising to the upside. There is a view that the deregulatory and tax impulses from the Trump administration are going to be positive, and people are kind of following through on that. So yeah, I think sentiment is actually pretty positive. If I had to summarize it, people are long U.S. versus rest of the world in the equity space, and it's going to take something to kind of shift that trend.
I was going to say, I mean, we should be clear. It's good sentiment around the U.S. That ETF figure, it's been outflows for the rest of the world, for Europe, for emerging markets, for Asia. What does shift that? Is there anything, or is this going to continue to be a U.S. exceptional market? And Europe and emerging markets, we're going to struggle to buy.
Yeah, look, I think the concern we've heard about EM and Europe is more that they are consensus underweights and consensus shorts. So you do have sort of a positioning dynamic that could kind of disrupt that. But again, you need a catalyst to do that. So what is that catalyst going to be? Look, you have a lot of elections coming up in Europe that could impact it. You could get large China stimulus, and that could really support things. The question is, from an equity investor's perspective, is there going to be follow through on that? If you look back to China 6 weeks ago, they kind of surprised the market. Then they went into Golden Week. The market was very excited. You came out of Golden Week, and they just didn't follow through enough. So I think both for Europe and China, you could have episodic periods of outperformance, especially given the positioning dynamic. The question is follow through. And if you don't have that follow through, then the U.S. is going to be back in the driver's seat.
Does it concern you that it feels like everyone is pretty much lining up, and this is all consensus right now?
It does. I mean, from a positioning perspective, it does. Like if you rewind 12 months, this was the case in small cap, right? You had everybody was really deeply underweight in short small cap. The Fed guided to rate cuts, and boom, you had this massive sort of positioning driven rally in small cap. Same thing happened in July, to be completely honest with you, when you got that friendly inflation print. So the positioning and sentiment setup is a little bit offsides, to Lisa's point, on U.S. being sort of exceptional versus rest of the world. The problem is when that comes up, the next question is, okay, well, then what do I own instead? And that question is very hard to answer now. It's hard to convince someone to sell the U.S. and buy European equities right now, or sell U.S. and buy EM. So yeah, risk reward wise, it does kind of concern us fundamentally. It kind of makes sense.
What if Trump gets his entire wish list and we see a ton of fiscal spending and bond yields go up? Then what do you do?
Bond yields to us is the number one market risk to equities. So that longer end bond yield, I mean like 30-year type bond yields. To me, that is the number one market risk. The number one data risk is on the labor side of things. So those are the two things we're trying to manage. Our view is B-log equities, but hedge sort of bond term premium kind of dislocated to the upside. So yeah, I agree with you, massive risk. And I think that's the key kind of market risk out there in the system right now.
What about cash flows? Because a lot of the optimism has been cash flows are higher, they're going higher. What happens if all of a sudden we have companies that are going to face pressure to be investing in the U.S. and domestic industry?
I guess, we'll have to see, like, what does the CapEx outlook look like? What does the buyback outlook look like, relative to that? Generally speaking, large cap U.S. corporates, the safest balance sheet in the world right now. So they have the capacity to spend. They have the capacity to do that. I think the question is, are they getting forced to do a spending sort of program that is inefficient and sort of destructive to ROE and margins. If that's the case, then yeah, you have a risk because that EPS number is sort of high in the out year. But look, if they're just being encouraged to invest and incentivized to invest in the U.S., then that's not necessarily a bad thing, I don't think, for the market.
Well, to build on that, how much is signal and how much is noise in some of the recent rotations away from maybe some of these small caps into large caps, into big tech, away from some small caps? I mean, you talk about how some of the positioning shift really indicated euphoria to you before. Why are tech stocks outperforming small caps by so much over the past few weeks?
Yeah, it's a good question. I mean, last week in particular is one of the bigger weeks of sort of large cap tech and growth outperformance that we've seen in a long while. It's kind of reversed a little bit this week. I think some of that is basically just the ebb and flow of markets and positioning. And some of that is if you have ETF buyers and foreign buyers, I think that demand source tends to focus on larger cap U.S. equities, to be completely honest with you. You know, foreign investors, I think, want to own large cap U.S. tech because that's something you can only find here. ETFs tend to go into Qs and SPYs and things like that. So I think some of it is just a normal ebb and flow, and some of it is the type of buyer that we're seeing generally gravitates towards that type of stock.
You know, 2024 has been an amazing year when it comes to stock returns. Why does it feel so exhausting and so ready to end?
I mean, it's a good question. I would like to blame it on politics, but Emery's here, so I'm not going to.
What about the market coming into the year? Into the year, 6 or 7, 8 Fed rate cuts.
Oh yeah,
we've had 2.
Oh yeah, blame it on that.
Look, I think look, you definitely have had some data surprises that have gotten us. You've definitely had a little bit of politics that have gotten us as well, and even the weather's been bad. I mean, it's just been a tough year all around.
Stuart Kaiser of Citi, thank you so much. Hopefully, 2025 will be a brighter year, if not for stock returns, then at least for the weather. Let's get to an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackett. Yahira.
Hi, Lisa. Macy's shares are falling in the pre-market. The company reported third quarter earnings that missed slightly on revenue and net sales, and a miss on the outlook as well. Macy's seeing its full year adjusted earnings per share coming in at a lower range than expected. The results coming after a weeks-long delay after an investigation late last month revealed an employee hid more than $100 million of expenses over several years. Shares are down 8%. Meanwhile, shares of U.S. Steel are up slightly in the pre-market, about 0.3%, but that's after plunging yesterday when we reported that President Joe Biden plans to formally block the $14.1 billion sale of the company to Japan's Nippon Steel. According to sources, he plans to do this later this month, citing national security concerns. U.S. Steel said the deal is a lifeline and warned it may shutter some operations if the merger collapses. And Kroger's $25 billion acquisition of Albertsons has been blocked by a federal judge. The judge saying the takeover would lessen competition for U.S. grocery shoppers, siding with the U.S. Federal Trade Commission. The two grocers are now reviewing next steps, with Kroger considering an appeal. The company spent nearly 2 years attempting to merge, with Albertsons aiming to become a bigger player and compete against larger non-unionized rivals like Walmart. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the weather. No, just kidding. Biden taking aim at Trump's tariff plan.
He seems determined to impose steep universal tariffs on all imported goods brought to this country. Who do you think pays for this? I believe this approach is a major mistake.
That's coming up next. This is Bloomberg Surveillance. "75 minutes until that key CPI print. Will it be an upside surprise?" That's basically what a lot of people are trying to figure out. This from Bank of America, derivative strategist saying the market is underpricing CPI risk. We believe CPI matters more this time. Don't tell it to S&P traders, because basically futures up 0.1%. You could see a bigger outperformance on the Russell 2000. Across the board, yields ticking just a third for a fourth straight day if it closes this way. 424.77 on the 10-year, and dollar strength pretty much across the board on the heels of a couple of key signals coming out of China and Japan. Under surveillance this morning, Biden takes aim at Trump's tariff plan.
He seems determined to impose steep universal tariffs on all imported goods brought to this country, on the mistaken belief that foreign countries will bear the cost of those tariffs rather than the American consumer. Who do you think pays for this? I believe this approach is a major mistake.
Here's the latest. President Biden saying President-elect Donald Trump's plan for broad tariff hikes will hurt American consumers. Biden taking an economic victory lap even after his policies were widely seen as contributing to the Democrats' election loss. Joining us now is Monica Guerra of Morgan Stanley. Monica, thank you so much for being here. Happy holidays. I think we're doing that now. I wanted to start with what you make of President Biden trying to put certain things into place, rushing to do so ahead of President-elect Donald Trump taking office.
Yeah, this is all about legacy setting. I think that's pretty clear. He's trying to get as much done in the next, 3 weeks, 4 weeks as possible. What we're likely to really see is a move towards trying to keep jobs in the U.S. That's essentially what Biden's trying to do. He's trying to say that I have a strong economic legacy as well, despite what the electorate might think. And although he might be stopping this deal around U.S. steel, what we're likely to see is, a pro-deregulation agenda under Trump that might essentially flip that on its side. So Biden can try to get as much through as possible without really strong legal structures in place. That could make that legacy still easily unwound by the next administration.
Before we get into Trump, Biden and I reported overnight that they're looking on fresh sanctions, a lot harsher sanctions on Russia, basically waiting to the last minute till they leave to, one, this put Trump in a rock and a hard place, but also give a little bit more support to Ukraine. Do you think we're going to see a lot more of those kind of actions on the foreign policy front before they leave office?
So we don't have a view on sanctions. I want to make that clear. But what you're likely to see is, again, Biden sort of reaffirming our commitment to Ukraine, trying to reaffirm channels with NATO, essentially reminding everyone, right, how different policy-wise what the Biden administration is from the Trump administration. And so that is going to be the dynamic that we're going to see over the next 4 weeks. Really, again, reminding the public, reminding the world what his legacy is. And one of the things that we saw in the last, 24, 48 hours, it was this move towards reaffirming his IRA bill, right, the Inflation Reduction Act, and getting that money out the door. That's part of this legacy-setting agenda. And while the Trump administration has had a very aggressive rhetoric, right, around anti-climate change, pulling back on clean energy tax credits, et cetera, it's our view that actually clean energy is likely to do well under Trump. What we saw during the Trump administration is that clean energy outperformed traditional energy, and it was vice versa, converse underneath Biden. So even though they had all this fiscal spending, all these tax credits being offered, clean energy underperformed. And that's really because a lot of the clean energy sector functions like a growth stock. And so that's what we're focused on, and on the clean energy play, is that even though there's all this legacy setting happening and that one president or administration might have a priority, you also have to look at market technicals as well as global demand.
So let's talk about something Trump said last night, which a lot of people are questioning. Fast permits, if you have $1 billion investment into the United States. I immediately thought of, well, isn't that Nippon Steel taking over U.S. Steel? What does he mean by this? Or is just something he wants to throw out there for a vibe?
I think we have to see how that would actually be interpreted. What are the deals? If we are backing off on M&A aggressively as far as monitoring that through the FTC, that could allow for faster permitting through faster deals, moving through the legal system more quickly. So that's a bigger picture sort of umbrella structural change. Now, I don't think it's all smoke and mirrors, because it reaffirms his commitment to that pro-growth strategy and policy. So lower taxes as well as that deregulation play. This is just part of that narrative. How it actually plays out, we have to see, because I don't know what those investments are, right? We don't know yet. And we don't know what agencies would be involved and what permitting, right, would be involved. So again, we have to see how it goes, but it's essentially
Are they American? Are they foreign?
It sounds like it would be foreign, right, as far as bringing investment to the U.S. That was my interpretation of his statement, is that it would be from, offshore coming to the U.S. Again, part of that, right, pro-growth, America First policy, right, essentially bringing jobs here. And that's where you see a little bit of this conflict between Biden and Trump, is that Biden is saying, I'm not going to let U.S. Steel go offshore. Right? That's one method of trying to save American jobs and be pro-growth. And then you have the other, right, which is the Trump strategy we just talked about.
But that pro-growth strategy has already got the soft data ticking up a lot. There was, from the Business Roundtable, a CEO Economic Outlook survey. and CEO optimism is the highest in over 2 years. The details of what they said I thought was really interesting. They pointed to a lot of what you're saying about pro-growth, but said that he will avoid the overly broad tariffs. Are CEOs of America, is corporate America ready if there are some serious tariffs put into place?
It sounds like they're not, right? If that's what the survey says, it sounds like that folks are not preparing for that. And really what we have to track when we're thinking about our investors and our clients is if this is sweeping, what does that mean for really the consumer and constraints there? And then if it's not, where are those idiosyncratic risks? And how can we signal ahead of time and get ahead of it with our clients? And so that's really what we're focusing on when we're interpreting the tariffs.
What about regional exposures as you interpret the tariffs, as you interpret the various picks for various positions? How are you seeing what fares the worst, whether it's Europe, Latin America, or Asia?
So across those lines, obviously Asia would fare worse. You're thinking, again, this continuation of the aggressive U.S.-China tariff regime. I think that the Mexico, Canada, USMCA 25% tariff could be soft. I think that is more of a talking point. It's part of this broader renegotiation that'll happen in 2026, and there's a lot that can happen in a year. So I'm not as bullish on the 25% on Canada and Mexico. But obviously, Asia is going to be a primary target for not only Trump but also Rubio in their international affairs.
On the domestic front, we are getting some of the personnel. The chessboard is filling in, and one of the members, one of the chess pieces, is Andrew Ferguson to come head the FTC. And I do wonder what you think that means with respect to handbags and grocery stores, not necessarily what it means to big tech, but do you think that Andrew Ferguson would be more amenable to some of these deals getting through and kind of reinforces the optimism that we're seeing about some sort of M&A boom?
Yeah, I absolutely agree with that statement, that it could reinforce that M&A boom across the board. What we're looking at is not just tech. I know that's how we have tended to think about it, is that's tech industry, but also for our own industry, financial services, we think that there's likely to continue to be M&A activity there. So I think that it's going to be sweeping and it's going to be a top-down order, much in the same way that when Lina Khan stepped in, she completely changed the tone of the agency. So this is really his opportunity to reshape that.
Is there going to be, though, a thread that follows through from Lina Khan to Andrew Ferguson in terms of big tech? Because that is something that we've seen Trump talk about. And also Trump's FTC in the first iteration, Trump 1.0, were the beginning of some of these big tech crackdowns. You think of the likes of Google.
So one of the things about big tech that I always like to emphasize from a policy perspective is that the biggest players in the room have the ability to respond to the DOJ, the FTC, any sort of actions that they can take because they have enough revenue, right, to respond. It doesn't hurt their valuations over the long run. Where I would say the real risk is on tech would be if they continue to focus on smaller companies, and so that deregulation play is going to help growth more significantly. Obviously, on the upper ends, you can be a little toppy already.
Monica Guerra, thank you so much for being with us. Monica Guerra of Morgan Stanley, as we assess what the potential ramifications are from the chessboard in Washington, D.C., and frankly, in Mar-a-Lago, Florida. Right now, we're watching Macy's shares fall more than 8% after downgrading their full-year forecast. A real question here, Danny, about how much this really goes to a fundamental weakness versus just simply an errant employee.
Right. They're using this as an excuse, but is this just another excuse like people aren't willing to pay as high prices anymore that mask over a strategy issue more broadly?
Which is the reason why you've got activist investors circling around this storied name. Coming up, more on what we see going down in Washington, D.C. Congressman French Hill, as President-elect Trump looks to boost American industry, and as he has his eyes on the Financial Services Committee. This is Bloomberg Surveillance. Just 2 hours away from the cash open, also 1 hour away from a key data point ahead of next week's Fed meeting. Stocks trying to claw up in terms of some gains after 2 straight days of losses. NASDAQ outperforming. Let's get some specifics with your morning movers. Here is Manus Cranny. Manus.
Lisa, admitting that you've got a material weakness in your internal control. That's essentially what Macy's have admitted to. It has had a consequence. They've closed off their accounting issue. They've lowered their full-year profit outlook. And really, this is to do with the earnings per share, 225 to 250, down from 290. They're going to have a nip at the margins as well. This is the intentional hiding of $151 million in expenses. That hit the line at Macy's for $79 million. But as I say, they raised their full year outlook. They're also contending with an activist investor who wants buybacks, who wants optimization of value, and that may mean rethinking the strategy and separating off the real estate as well. So there's a lot to contend with in today's announcement. GE Vernova, think about the gear maker for wind business in this country and the gas plants. They're saying we have humble wind orders. Onshore wind is flat. Why? Because the data centers are chewing up energy, and they're chewing up energy from gas. Gas is the number one driver, 24-hour power delivery to the data centers. That frenzy in gas is driving gas over wind, and reliability is the critical issue there. So it's going to be time before the energy that the data centers want, really rely on wind. GM, Mary Barra, again, rectifying some of the strategy here. This stock, she scrapped her robo-taxi business that she bought in 2016. It's called Cruise. It's going to save them about $1 billion a year. They're saying this is a crowded, competitive market. Just think Waymo. Waymo's worth $45 billion at the moment. And then you have Tesla coming into that space. So, yes, Mary Barra put $850 million into Cruise to keep it going in the earlier part of the year. This is a truth and reconciliation moment. That part of her business is over, and the talent that was driving Cruise, excuse the pun, will be folded into autonomous driving, along with a number of other teams about advanced, safe driving. So that's the news flow from GM.
Thank you so much, Menace. I really appreciate it. Right now, we're focusing on stories elsewhere. Under surveillance this morning, President Biden saying he will formally block the $14 billion sale of U.S. steel to Japan's Nippon Steel. A source is telling us here at Bloomberg he will cite national security concerns when the deal crosses his desk at the end of the month. And you can make different arguments about this takeover by Nippon Steel and the viability of U.S. steel alone. But there is this question of the way this has gone down, Emery.
Everyone is talking about the fact that this looks very political. CFIUS is supposed to be about national security concerns, not because it's an election year and you're trying to shore up votes of rank and file union workers in Pennsylvania. But President Biden and President-elect Trump both said that in this gut, really, for protectionism, that they would block this deal, that Nippon Steel should not be able to take over U.S. Steel. What I find fascinating is that still a lot of political pressure around this. Nippon Steel feels like a last-ditch effort, has worked for months to build support, announcing separately yesterday a plan to offer $5,000 bonuses for every steel worker if the takeover closes. Last-ditch effort that I don't think is going to work.
Well, they wanted the union on their side. Throwing some more money at the workers might help with this. But again, there is this irony, and Anne-Marie, you pointed to this idea that, hey, if you had waited a little bit, maybe you could have gotten this done under Trump. Trump doesn't want this, but of course he had that post yesterday saying, hey, if you spend more than $1 billion you invest in here, we're going to speed up permitting. This is a case where Nippon Steel was trying to do just that, and it really speaks to the difficulty of navigating a business environment in 2025 when you can have these broad sweeping statements for Trump, but maybe some of the details don't play out that way.
Which is the reason why people are looking at national security, doing the heavy lifting at a time when otherwise investment is a priority. President-elect Donald Trump also selecting Andrew Ferguson as his pick for FTC chair. Trump saying, quote, Andrew has a proven record of standing up to big tech censorship and protecting freedom of speech. Ferguson currently serves as an FTC commissioner. He's one of 2 Republicans on the 5-person panel. And Danny, to me, this is fascinating at a time where we're talking about a resurgence in mergers and acquisitions.
We are, but where, I guess, is the question. Where are we going to see that resurgence? Clearly not when it comes to some issues of national security, and maybe not tech. One of the interesting things, though, is he might let some AI kind of run. He basically said, we shouldn't be giving AI a lot of scrutiny at this moment. We should give it time to really develop. He compared it to putting regulation on the airline industry just a day after Kitty Hawk. Of course, AI develops much more quickly. So on one side, he wants big tech to kind of get away with the censorship and crack down there. On the other side, he wants AI. I mean, it's different little pieces that I don't think we fully appreciate where they're going to fall into line.
Which is the reason why this story caught a lot of people's attention. A federal judge blocking Kroger's proposed $24.6 billion takeover of Albertsons, saying the acquisition would lessen competition in the grocery space. A real question here, Anne-Marie, about how much this is going to be the status quo and whether it will stay or whether some of these deals will get revived under the new administration.
Well, definitely a parting gift to Lena Khan in terms of her leaving the FTC chair, but she's come under a lot of harsh criticism from Republicans and business groups about deals like this. Not when it comes to big tech, but about deals like this, about Albertsons and Kroger, about the handbags tie-up, deals that most people thought, sitting on the sidelines, looking at all this play out, actually mergers that maybe should be able to go through. Maybe that's the different kind of touch you get with Andrew Ferguson.
Meanwhile, President-elect Donald Trump looking to boost U.S. investment. Trump writing on Truth Social, any person or company investing $1 billion or more in the United States of America will receive fully expedited approvals and permits, including but in no way limited to all environmental approvals. Get ready to rock. Republican Congressman French Hill of Arkansas rocking a green tie with lots of dogs on it, joining us now. Congressman, I want to start with this question of how available Congress members are going to be to implement some of these proclamations on Truth Social. I know that you are up for leading the House Financial Services Committee. What would your priorities be on day one?
Well, first, Lisa, Anne-Marie, great to be with you. First, I think we have to coordinate with the incoming Trump administration about their regulatory priorities. That's number one. Number two, we want to roll back the most egregious, burdensome part of the Biden-Harris regulatory agenda, whether that's at the CFPB or the SEC or through the bank regulators. We want more clarity, more transparency, less cost in the system while preserving safety and soundness. Next, we need to pursue something that's unfinished business in this Congress, which is to create a market structure for digital assets and bring up that clarity for innovators, for coders, for venture capitalists who are engaged in the next range of investment in the Web 3, which has got blockchain as a critical feature of it. So I'd say those are some of the top priorities among many, but those are some of the top priorities.
So those would be your priorities if you were to get the gavel. I'm told that this has been very competitive to lead this committee. We're going to see this vote take place in the next 24, 48 hours. How close do you think you are to leading the committee and getting the nod?
Well, I've worked very hard over the last few months to talk about my vision for the committee, my ability to be ready day one to implement President Trump and House Republicans' financial services priorities and regulatory rollback, using budget reconciliation, making community banking great again by both legislative and regulatory changes, countering China. So I've talked about my experience. I was a private sector bank CEO. I've been a de novo bank founder and CEO. I've been a public company director and, of course, worked in both the executive branch and the legislative branch, specifically on economic and financial services policy. So I've talked about why I believe I'm the best candidate based on that management experience, that ready-to-go vision I have for the committee, and the work I've done here in the House.
When it comes to the first 100 days of the Republican sweep through the House and the Senate and the White House, there's a debate now. Incoming Senate Majority Leader John Thune is talking about that he wants to do two bills, border and energy in one and tax cuts in another. But your colleague in the House, Jason Smith, wants one large package with immigration, energy, as well as those tax cuts. What do you think is the best path forward?
Well, Anne-Marie, what I think we have to do is be on the same page. I think Senate leadership led by incoming Majority Leader John Thune, our great Speaker Mike Johnson, and the incoming leadership in the Trump administration need to have their own view and have it be a consistent and combined view for both the House and Senate. I think that maximizes the leverage we have for using budget reconciliation. You have to navigate the parliamentarian in the Senate. You have to make sure you have a clear plan. But most importantly, in a narrow majority in the House, we've got to make sure we have Republican-only votes for that. So that's why I think all three parties, the executive branch, the House and Senate, Republicans all need to be on the same page.
Congressman, we talk a lot with different investment managers about the sequencing next year and how things are going to get through from President Trump's agenda. People talking that probably we're going to get tariffs first. We see a great willingness to do that. Do you understand the mechanism by which tariffs bring revenues into the country in a way that could actually offset the deficit?
Well, that's a big step to make the assertion that tariffs are somehow going to offset a $2 trillion deficit that is projected to be at that level for the next 10 years. I think this is much more about setting long-term spending reform and spending priorities as opposed to that you're going to balance the budget through some revenue mechanism. We need to get serious about prioritizing discretionary spending, but that's only a third of the budget. And we really need a bipartisan, bicameral process to make long-term spending reforms in what we think and call the mandatory spending programs, which is 80% of the budget. If we do that, we'll put America's financing on a much more sustainable course, and that will be the ticket, in my view, to countering China, meeting all of our domestic priorities, and having a long-term future that doesn't continue to indebt the next generation.
So what do you think the end goal President-elect Trump has when it comes to the tariffs he's discussed on the campaign trail?
Well, I think he wants to use tariffs as a major cudgel in bringing people to the negotiating table. And I believe one of the priorities will be make sure that the USMCA, which he negotiated as president and replaced the North American Free Trade Agreement, is working just as American policymakers believed it should. Maybe we could strengthen it, make sure that people can't take advantage of it inappropriately. And perhaps we could even add countries to it, which I think is an exciting prospect, to use that as a real inducement to get more partners, trading partners for the United States, Canada, and Mexico. And I think that would be a real ticket to bring FDI, that the president talked about yesterday, foreign direct investment, coming into the United States.
Congressman Hill, just to be clear then, is it your expectation that we will not see sweeping tariffs, that it is simply a negotiating ploy?
I think it's a principal cudgel that the president has in bringing people to the table to get better open access for American products and be treating our services and merchandise fairly and make sure that we can get into other countries on a fair and equitable basis. And over the years, that's really deteriorated. And I think that's the purpose of using tariffs, is to say you're not going to dump your products into our country at subsidized cheap prices, and we want access to your markets.
Congressman, before we let you go, one other big question that we keep hearing about has been how much of the DOGE committee can really push through some of the efficiencies that can help offset a number of the expenditures. How willing do you think Congress members are going to be to sign off on some of the proposals to cut staff dramatically across the board?
Well, look, I think the DOGE exercise led by Elon Musk and Vivek Ramaswamy is a good one. I think having outside voices take a look at the calcification and the barnacles that have been built up on the hull of state for decades is really important. And I think they'll have ideas that can be done by executive management on being more efficient in procurement or policies about employment. But a lot of the tough changes will come that they'll recommend and will have to be vetted by Congress and approved by Congress. And I can say on the House Republican side, tremendous enthusiasm to see these two successful business guys brainstorm, work with the cabinet secretaries, and make constructive recommendations for making the government better, more efficient, and of course less costly to the American people.
Congressman, thank you so much. You are very generous with your time, and we look forward to speaking to you after that Thursday vote. Congressman French Hill over there of Arkansas. Right now, continuing with Washington, D.C. news. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Senate Republican leader Mitch McConnell is set to be fined after a fall in Washington yesterday. Senate colleagues say McConnell tripped following a lunch and suffered a sprained wrist and a cut to his face. A Senate spokesperson saying he's clear to resume his normal schedule. McConnell, at 82, is the longest-serving party leader in the Senate's history. He will finish his Senate term through 2026, but Senator John Thune will take over as majority leader next year. Meanwhile, the value of Elon Musk's SpaceX has jumped to $350 billion, according to an email to employees Seen by Bloomberg, investors have agreed to purchase as much as $1.25 billion of the rocket and satellite maker's common shares at $185 apiece. The valuation cements SpaceX's status as the most valuable private startup in the world. And the Yankees may have lost the Juan Soto sweepstakes, but did make a major upgrade to their pitching rotation. Two-time All-Star Max Fried agreed to an 8-year, $218 million contract. That's the largest deal for a left-handed pitcher in history. The former top 10 pick in the draft is coming off a stellar 7-year stretch with Atlanta, holding the league's lowest ERA over the last 5 seasons. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I mean, if a team wants to pay that much money for a pitcher for 8 years, they can do that. But,
Welcome,
whatever.
Max, but I'm still sore over Juan.
Well, it's okay. You should be. Anyway, up next, the state of U.S. retail.
Certainly at the low end, consumers are incredibly fickle because they're the most economically distressed. But even at the high end, we see a lot of fickleness.
Is that what we saw at Macy's? We'll be breaking that down coming up next. This is Bloomberg Surveillance. "41 minutes until a key CPI report. Just getting this crossing the terminal that OPEC is cutting its oil demand growth forecast this year for a 5th straight month, making its deepest reduction to its outlook for the year so far. And Anne-Marie, this sort of emphasizes why you're not seeing more of a response in crude to some of the geopolitical concerns elsewhere.
Absolutely. The fundamentals have been very weak and soft for the oil market, especially the fact that they're seeing this softness in demand in China. OPEC hasn't been able to put barrels back on the market, and this is the reason why.
We'll have more on that story coming up. In the meantime, eyes very much on Macy's shares under surveillance this morning. The state of U.S. retail.
Certainly at the low end, consumers are incredibly fickle because they're the most economically distressed. But even at the high end, we see a lot of fickleness because those consumers, while they're still flush with cash, they have so much choice. And we see that in some of those U.S. numbers. And that's absolutely an issue that every business that is trying to attract higher end customers has to face.
Here's the latest. Macy's shares taking a hit in pre-market trading. Third quarter earnings coming in below estimates, with the retailer cutting the profit outlook after an employee intentionally hid over $150 million in delivery costs. Macy's saying it found material weakness in its internal controls. Joining us now is Dana Telsey of the Telsey Advisory Group. Dana, what went wrong with Macy's? Was it really just an errant employee?
I think overall you also had a very pressured consumer during this time period. We had the unseasonable weather. You did see some improvement, like in their Bloomingdale's division, where the comps turned positive from negative. But it is a challenging landscape out there, and the weakness in Macy's this quarter, yes, that delivery expense was the gross margin, given that the merchandise margin was down 70 basis points. The go-forward outlook and the adjustment to guidance for the year really came from the gross margin side. Because when you look at some of the other initiatives put in place, like the first 50 locations, they continue to see accelerating positive comps, given the service that's being added. And one other thing is that they announced an increase in the number of store closures for Macy's this year, going to around 66 from what previously was expected at 55.
Macy's shares are already down some 14% so far this year, and it raises a question when they put out a warning like this that they have found material breaches in their internal controls. How endemic is this to just management style overall?
Keep in mind, you've had different CEOs over a time period, even like 10 years in terms of 3 different CEOs. You have a new team that just has taken over now. Obviously a large company, but controls matter. And it certainly showed in this what happened in terms of how those controls are going to be strengthened. Anxious to hear on the call what happened and how it's going to be addressed going forward. And I would say many companies need to look at their controls in order to assess that you don't have these breaches and you don't have this conduct, with enhanced internal and external audits.
Just to be clear then, Dana, is there an idea that other companies
aren't up to snuff in this, that this is an industry-wide problem.
This was definitely Macy's alone. We haven't heard anything else to say that other companies are doing this, but we certainly have over the years. When you had COVID, we've seen companies increase and accelerate the audits that they do of delivery expenses and what's happening with all the omni-channel initiatives.
How much is Macy's being really lifted by Bloomingdale's and Bluemercury, not actually Macy's?
They're being lifted by them in many ways, not just the sales part of it, but also on the merchandising part to better understand with Macy's what product trends can be gleaned into the core Macy's business too. When you think about Bloomingdale's, when you think about Bluemercury, and you think about the size of Macy's, over $20 billion in sales, it is Macy's that is the bulk of the revenue. Those are much smaller entities compared to what you're generating for Macy's.
I'd love to get your thoughts on what you're seeing in terms of holiday shopping spending, because earlier today out of Europe, we got Inditex, which is the owner of Zara, and they reported slower sales growth. And this is at the start of the holiday season.
Keep in mind, Inditex's sales, exactly like what you said, they're up 9% from November 1st through December 9th. When you look at the prior read that they gave, it was up 11%. And the stock is down because of that deceleration in sales. We've heard through our checks globally that Inditex has seen around the world, whether it's in Canada, whether it's in Europe, whether it's in North America, a slower sales rate. And so that impact, when you're looking at a trend-right retailer that like Inditex, it's not just a Macy's issue. It's what's happening with how the consumer's spending on discretionary goods. Newness and innovation are what drives that spend. You look at Macy's, which talked about the strength of fragrances that they had, contemporary advanced apparel. It's got to be new in order to drive demand.
When it comes to the fix for some of these things, I mean, Macy's has activist investors. What they're recommending, put real estate into a separate company, cut investment, aggressively buy back shares. That's not innovation, what you're talking about. Is there a risk that some of these companies are veering more towards financial engineering and not actually fixing the offering and culture?
One of the things you're seeing in fixing the offering and culture, look what you've had with companies like Abercrombie & Fitch that's newer today than what it was. Frankly, look at even companies like Coach with the Coach brand of what they've done to reinvigorate. It can be done, it takes time. The financial engineering of whether you split off real estate or do anything else, investment in stores is critical in order to present an experience that matches the goods that you have. And if you're going to split off the real estate and it's a sale leaseback, well, guess what? You still got to pay rent. What do you need? You need sales increases to deliver on those numbers.
Right now, we are seeing Macy's shares down almost 10%. Dana Telsey of Telsey Advisory Group, thank you so much.
Thank you.
For being with us this morning. And a real key, as Dana was mentioning, 5 minutes time, we do get that call with management for them to give some explanations about what actually happened. Honestly, and on it, Danny, to me, that's really a key question at a time where do we really understand shipping costs and how one person can cause a $100 million gap?
I was going to say, we learned about this a while ago, and I still don't understand it. I think a lot of people are confused and want questions and want to know how much is Macy's just using this as an excuse. As we were just talking about with Dana, this idea that changes can be made. You can fix your offering. You can get there. So maybe, some companies just saying, things will go by. Maybe consumers will come back. In the meantime, though, you need to change things and maybe can't just keep relying on old excuses.
Which is the reason why we're hearing about property sales as well as some other initiatives. Coming up next hour, it is the key hour with CPI coming up. Binky, Chadha of Deutsche Bank, Deborah Cunningham of Federated Hermes, Jay Bryson of Wells Fargo, and David Kelly of JP Morgan. Stocks kind of grinding around, trying to find direction ahead of this key inflation rate in the United States, the last big data point ahead of next week's Federal Reserve meeting. This is Bloomberg.
It ultimately comes down to whether or not we see a unexpectedly higher CPI number.
If inflation suddenly starts to reverse, that could really cause it to pause at the December meeting.
If we get a stronger reading, then what you would see them do, I think, is still cut in December, but say, we might be at that point where we would slow the pace of cuts.
We think that there is going to be a bit of upside surprise in these numbers.
Maybe we are either moving sideways or actually having a risk of inflation beginning to move higher.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. 30 minutes until we find out just how willing consumers are to accept higher prices. Stocks trying to turn around 2 days of losses ahead of that key CPI print that we get in about 30 minutes time. This is a moment that a lot of people are trying to figure out. Are we looking at an economy that has more inflationary pressure than we previously realized at a time where maybe, Danny, there just is a feeling of tiredness with how far and how long this rally has gone?
There is, and that's why maybe we've seen some of the pauses, but we are seeing some more fear, perhaps, that inflation is not dead. And today might confirm that. Bloomberg Surveillance of Deutsche Bank just out with a note saying that it's important to look that U.S. data is already pointing to a significantly more inflationary direction. He points to housing inflation, forward indicators that are picking up, immigration flows that have already slowed. So he says, look, even if we get a cut from the Fed this month, it's going to be a long pause after that.
And Deutsche Bank was talking about actually it might be more than the 0.3% month over month that the market is expecting. And if that's the case, that would actually be the highest monthly number in 7 months. So what does this mean already when everyone's talking about next year's policies that could be inflationary? And it's just a reminder that what a lot of economists told us in the very beginning as the Fed said they were going to have this fight down to 2%, the last mile is going to be the hardest and it's going to be the stickiest.
Which is the reason why Bank of America derivative strategists came out overnight and said the market is underpricing CPI risk. And then we get this. Macy's comes out and explains why it saw, maybe giving some more light at least, on why it saw $100 million removed off its top line from an errant employee. It just raises a question, Danny, about how much we're seeing consumers push back in real time about how much they're willing to spend, about how much they are willing to buy at a time when otherwise things are kind of reaching equilibrium, this idea of disinflation.
It's such a weird thing to look at a Macy's and look at these various consumer discretionary companies that are struggling on one hand, and on the other hand, have a conversation about airlines and say, everybody is going to be traveling to Europe, everybody's spending all this money, everybody is going on cruises. It's not a consumer that has stopped spending, but they're stopping to spend if you don't have a strategy to really capture them. They just don't have the money they once did to buy basically everything under the sun.
It's the idea that people are still hungry for services and experiences while goods inflation has come down.
Well, we are seeing the experience of the market trying to claw out some gains today after 2 straight days of losses. The S&P futures just kind of bouncing around more or less 0.1% gain. You could see that outperformance on the NASDAQ. Dollar strength across the board, 105. On the euro dollar cross, you could see yields creeping just a bit higher. It would be the 4th straight day of yields ticking higher on the 10-year ahead of that key auction later this morning, and crude prices off their earlier highs as we did get that OPEC news on potentially a reduced demand. Here's what we got coming up. Binky, Chadha of Deutsche Bank with stocks looking to bounce back from 2 days of losing. Deborah Cunningham of Federated Hermes on why investors can keep cash on the sidelines, and David Kelly of JP Morgan on why there's little evidence of mounting inflation pressures. We begin this hour with stocks steady ahead of CPI due out in under 30 minutes. Binky, Chadha of Deutsche Bank looking ahead to next year, like all of us. Our 2025 year-end S&P 500 target is 7,000. From a demand-supply perspective, positioning is already near the top of its long-run band with little room to rise. We see robust equity and bond inflows continuing, boosted by strong risk appetite, though we are factoring in some slowing in the pace. Binky joins us now. And Binky, thank you so much for being with us. My favorite part of everybody's outlooks is explaining why people are not more bullish. Because you come out with this bullish outlook and then you say, look, it's just not going to be that quick. So pump the brakes a bit.
Yeah, I mean, I hate to use a very overused word right now, which is constructive, but we have been constructive for 2 years. And the fundamental reason for being constructive is really about the business cycle. That's what equities are about at the end of the day. And I would say, the cycle looks pretty good. There's a whole set of things that one can think about that just really haven't kicked in yet. I mean, we've had destocking that everybody knows about. We can't remain in a world of permanent destocking. So at some point that becomes restocking. If you look at CapEx, earnings outside tech have basically started to turn up. So we should start to get, CapEx. There's the biggest question, I would say, which is, the funk in manufacturing globally. Same is true basically in the U.S. And what you were talking about before, Danny, the services, so bigger picture, I would say the pandemic and the pandemic's rotations are still very much with us. But what I would add is, first, of course, that everybody knows about, we had this massive rotation into goods. Then over time, we had this rotation into services. What I would point out for the cycle, actually, is that today, services relative to goods spending looks to have overshot. So we might sort of be at that cusp of a rotation back into goods. And that would go a long ways towards, sort of normalizing things. And goods are, of course, more important for equities and earnings because they're disproportionately represented in the S&P.
It raises a question about the vulnerability to data surprises at a time where people have a hard time getting their head around which rotation we're in and how affected it is by the pandemic. How vulnerable do you see this market if we do say an upside surprise in CPI in 25 minutes' time?
I think it will lead basically to, modest pullback, perhaps, depending on the details. But what I would say is, sure, we are going to have bumps, but I would say the broader disinflation trend remains in place, especially if you think about it fundamentally. The inflation did not come basically from the traditional drivers. The traditional drivers for me are, the unemployment rate and the US dollar. The pandemic-related boost to inflation was worth basically about 4 percentage points. It's obviously come down a lot, but it's still 40 basis points. And I would say that's a force for continued disinflation. Most people didn't believe that 4% was going to go away. We're down to 40, so I'm sticking with the disinflationary forces basically remain in place. We will have plenty of bumps. I think Q1 and what happened in Q1 this year, the residual seasonality, I think all of that's well known. So I think it is going to be a little bumpy, but I think the broader trend, remains very much in place.
One of the other things we've seen a lot of 2025 outlooks and ones that do forecast the equity market continuing to gain is how you talk about valuations and how valuations are justified or not. UBS had theirs out this week saying that it's justified to be above the long-term average because of technology. BlackRock saying that the business cycle, it basically doesn't exist anymore because of the AI excitement and what that means. What do you make of that piece of the picture?
Yeah, so I think on valuations, the first point that I would emphasize is that it's not coming from here, it's not coming from there, it's coming from everywhere. The market is expensive. There's no getting around that fact. We're basically trading at 24 times trailing when the historical average is sort of 15 times, 15.3 times. But it's a big topic, but I would say there's also plenty of fundamental reasons for why valuations have gone up. And I would point out that valuations actually went up. So we just spoke about the 15 times. Just look at a chart of the S&P 500 multiple for the last 100 years. It's barely gone below. It's meant to be an average, which means you get sometimes above and sometimes below. But since the late 80s, early 90s, we've barely gone below 15 times. So that move up happened earlier. So the question is really to understand why it went up. I would say it's not something that happened this year. And so, obviously valuations went even higher this year. But what I would say is, number one, we basically now live in a 2% inflation world rather than a 3% inflation world. That's a little better for multiples, gives you a multiple point, maybe a little bit more, not a whole lot. But I would say the key thing that has really changed is payout ratios. Payout ratios historically ran between 50 and 60%. Late in the last cycle, we're running for several years closer to 80%. That's a 45% increase in payout ratios. And if you remember your present value math of, that tells you the fair value multiple should go up by 45%. Now that's probably too much, but there are fundamental reasons, and there are, I would argue, several others.
One of the things that when it comes to payouts that's really helped is just benign corporate credit spreads, that you can keep borrowing, you can issue large buybacks because of that. How much in 2025 are you looking to that market and seeing any potential widening that might disrupt some of these good trends?
Yeah, so what I would say, the leveraging up to do the buybacks, that's really a myth. Most of the buybacks come from the most unlevered companies. And the most levered companies don't do any buybacks. So, obviously there's a case here and a case there. And generally, levered buybacks produce negative, not positive reactions to the stock. So that's not really an issue. I mean, the way we think about buybacks is simply that companies get earnings, they convert it to cash flow, you pay out your dividends, do what CapEx you want to do, and what's left over basically is returned to shareholders in the form of buybacks. So, so we have buybacks next year going up in line with earnings, about 11%.
I'd love to get your thoughts on policy, because companies are waiting to hear about the tax cuts and potential tariffs, and you think the sequencing will be similar to Trump 1.0.
It's a working assumption, is the way I would put it.
Right. But why? Why do you think he'll wait so long for tariffs when, arguably, he's already negotiating tariffs right now with China, Mexico, and Canada?
Yeah. So when you think about basically a set of policies, and as I've said before, the way we think about it, and it's easy to talk about, there's various positives, there's various negatives. So if there's both positives and negatives, you've got to think about in terms of offsets. So, we've had very, very decent economic growth for at least a couple of years now. And so if you start with the negatives, you're going to lower it. If you start with the positives, you're raising it. And then, when you do the negatives, it's taking off of that. That kind of leaves you where you are, give or take in one slight direction or another. So to me, it seems just sort of key to do the positives first. In the current context, perhaps that's too broad-based sort of statements, but the taxes, if that's not the focus, you end up basically, in what could be a pretty sizable tax increase. So that has to be the focus that should be the focus to preserve or raise that growth before, you start to think of the negatives.
Binky, Chadha, wonderful to speak with you as always. Binky Chadha of Deutsche Bank here with us this morning ahead of that CPI print that does come in about 17 minutes. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. The suspect in the murder of the United Health Group CEO is being held without bail in Pennsylvania after fighting extradition to New York. Authorities in New York have gathered evidence against Luigi Mangione, including surveillance video, autopsy results, and written admissions. They're seeking his return to New York to face second-degree murder and weapons charges. He's due back in court in Pennsylvania on December 23rd, unless he's extradited sooner. Senator Bernie Sanders told Politico his term starting in January will likely be his last. The 83-year-old has been in Congress since 1991, serving 8 terms in the House before winning a Senate seat in 2006. Sanders was a top contender for the Democratic presidential nomination in 2016 and 2020, but was a runner-up both times. After Trump's victory last month, the senator called out the Democratic Party for abandoning the working class. And several items from Tom Brady's legendary career were auctioned off at Sotheby's, New York. The auction included rare watches and sports memorabilia, with the jersey he wore when he broke the all-time passing record selling for over $500,000. But the top items were Brady's watches, with the Rolex Daytona selling for over $1.1 million. The total value of items sold topped estimates, coming in at $9 million. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, the morning calls, plus Deborah Cunningham of Federated Hermes, as we count you down to that CPI report. That's coming up next. This is Bloomberg Surveillance. Thirteen minutes until the CPI report that will be the last major data release ahead of the FOMC meeting next weekend. Right now, you're seeing markets trying to eke out gains after 2 straight days of losses. S&P futures up 0.1%. I'm looking at 10-year yields up about 2 basis points, 424. 58. A question about how much it really sets the tone when we get CPI for the auction of 10-year notes later today. Time now for the morning calls. First up, Morgan Stanley resuming coverage of JetBlue with an equal weight rating, expecting demand to remain resilient. Next up, Deutsche Bank raising its price target on Southwest to $35, saying airline stock valuations remain attractive. And finally, JP Morgan raising its price target on Netflix to $1,010, citing strong content and healthy organic growth in all the households with children who are purchasing certain shows repeatedly and watching them when they should be doing their homework. Turning to CPI, due out in just a few minutes from now. The data could help predict the Fed's final rate decision of the year. Deborah Cunningham of Federated Hermes saying if policymakers slow the pace of easing due to concerns about inflation stalling or trending back up, money markets likely will see yields stabilize at elevated levels. Deborah joins us now. And Deborah, I really enjoy your notes and I enjoy your point because it really kind of challenges this idea of money on the sidelines. Does that money stay on the sidelines in those money market accounts if there is this sort of higher neutral rate for the Federal Reserve?
We definitely think it will, Lisa. The expectation had been, and, we'll see after the Fed's dot plot comes out next week, but it had been at 2.9% from the FOMC themselves. We had it a little bit higher at 3 to 3.25, but we're raising that. We're raising that at something that's more like 50 basis points higher, 3.25 to 3.75, based on what we think continues to be a pretty strong employment picture. An inflation environment that continues to be a little bit maybe disconcerting. It's stabilized. It's no longer coming down, and the expectation of policies from a new administration standpoint in 2025 that perhaps take those inflationary numbers upward again. When you look at immigration, when you look at tax law changes, when you look at tariffs, when you look at regulatory changes, all of those have the potential to become more inflationary in 2025. So I think the FOMC will be cautious, and rightly so.
This is really the reason why you have seen people pile into money markets, because they're getting yield, and it's risk-free yield, essentially. What you've seen is almost $2 trillion into money market funds from the lows of just this year alone to nearly $7 trillion. Deborah, how much of this do you expect to just stay, given what you expect from the Federal Reserve?
Our expectation is that at least 90% of it stays. Maybe there's 10% that's sideline cash that might move if they're enticed by, the equity market or some other aspect of their asset allocation. But quite honestly, if yields are still have 3 or 4 handles for a good portion of 2025, there's no reason, like you said, with it being a very low risk product, that doesn't continue to have appeal. And it's appeal broad-based. It's not just one sector. The retail trade into money market funds really drove the bus in 2023 and the beginning of 2024 from a flows standpoint. But institutional have kicked in the second half of 2024. And we think that both of those sectors, both retail and institutional, will continue to be strong from a flow and a gain in asset standpoint in 2025.
In the summer, though, Deborah, there had been this conversation that reinvestment risk is coming, that the Fed's going to start their cutting cycle, and that if you're not further along the Treasury curve, you're going to be missing out as yields finally start to drop. That's not what happened. We got a 50 basis point cut from the Fed, and since that point, 10-year yields have moved higher by 54 basis points. Deborah, what's the impact on investor psychology if those concerns of reinvestment risk literally played out the opposite as many had assumed it would?
Well, I think what you end up seeing is the extension trade being something that's talked about on a regular basis, but not necessarily undertaken. So within products, within our own products, within short-term bond products, those portfolios have extended by buying longer dated paper, but still within the range of the short end of the yield curve. And what we haven't seen is investors actually moving a lot of their cash from the shortest end, the money market end of the curve, out into even those micro shorts to ultra shorts products. Yes, those cash flows in those products have turned positive, but not in a major way that would indicate a trend change. So I think you still see that contemplation continue in 2025 without a whole lot of real movement out of the money fund side.
Well, Bank of America had a note out yesterday, which I guess I knew but didn't really think about until they laid it out, that every part of the U.S. Treasury curve beyond cash equivalents is still in a drawdown from the prior highs. Deborah, beyond cash equivalents, what place do Treasuries have in a portfolio right now?
Treasuries are obviously the most liquid, safest security in the world. But in a declining rate environment, even if it's not as much in a decline as what had been initially anticipated 6 months ago, or even 3 months ago for that matter, the portfolios that have a lag, weighted average maturity, like a money fund of 40, 50, 60 days, are going to keep a higher yield for a longer period of time. So particularly when you're looking at institutions who kind of choose between treasuries, direct securities and treasuries and money funds, their choice in this part of the cycle is going to be the money funds because of that lag. So I think, there are places, obviously, from a treasury perspective, and there's lots of treasuries out there that can be used for a collateral standpoint with regard to repo, which is, a big item for use within money market funds. But if you're comparing them particularly to money funds, I think in the current situation with rates continuing to be higher for longer, maybe not at the 5% level, but higher at 4%, then higher in the high 3%, you're going to want to stay in a product that lags those changes, and that's a money fund.
Deborah Cunningham of Federated Hermes, thank you so much for being with us. 6 minutes to go until we get that CPI print. And here is how we are stacking up in terms of expectations ahead of that. The expectation of the survey, 0.3%. In terms of month-over-month CPI gains, we can expect a 2.7% CPI year-over-year. That's up from 2.6% in the prior month. Meanwhile, if you're looking at a core, you're looking at 3.3% in line with what we saw the last reading around. Anne-Marie, it just raises this issue of how high is the bar for a surprise one way or another for this market to really wake up.
Right. The market this is the really last data point, because when it comes to labor market, it's okay. People say we're in an okay place now, even though everyone was talking about potentially the Fed thought the bias was to the labor market. Now people are worried about a potential reacceleration of inflation. And I go back to what the Fed was talking about in the sense that it seems like they want to cut, but they're waiting for the totality. And this is really the final number.
And it seems like a bond market that's adjusted. We like to talk about, is it offside some way? Is it going to surprise one way? And are we more vulnerable? The bond market pretty much flattened into this, positioning basically right-sized. So unless this is a huge surprise, is the bigger risk when we get the SEP, when we get the decision, and they maybe set themselves up for more optionality that after what's expected to be a cut is a long pause.
We might kick that surprise can down the road to maybe next week. Coming up next, Bryson of Wells Fargo and David Kelly of JP Morgan breaking down that key CPI print. I'm curious to see what the market does as important almost as the number itself. This is Bloomberg Surveillance. 25 seconds until the CPI report. The market shaping up as follows. You see gains in the S&P 500, more than 0.1%. You see the NASDAQ up almost a 1/3% as people parse through where the leadership really will come from. Meanwhile, yields inflecting higher, potentially for a fourth straight day as people take a look at potential upside surprises to that inflation read. Right now, with the data, Michael McKee. Mike, what do you see?
Well, what we're seeing here is basically what we expected, and that should probably keep the Fed on track. A 0.3 rise in the headline pushes the year-over-year headline number to 2.7%, and a 0.3 rise in the core pushes year-over-year to 3.3%. No change from the prior month. So basically what we're looking at is status quo with inflation. The only issue is that status quo enough for the Fed to go ahead with a rate cut? It doesn't seem like there's anything in here that immediately suggests that the Fed would have any problem with that. We'll have to check the three digits and see if it's a strong 0.3 or a weak 0.3. But I'm sure we're probably getting less market reaction than maybe, Lisa, you anticipated.
Michael McKee, indeed. Stay close, please, as you parse through the actual details. Very curious to see. In the markets, there is nothing to see here. Basically, a little bit of a downtick in two-year yields. You could see a bit of a pop in futures as maybe the tail risk of a potential upside surprise is taken off the table. Interesting to note the outperformance in the Russell 2000. And Danny, up now 0.8%, even with a much more tempered move in the yield space.
Right. And how long can that last? Because presumably small caps are rallying with the idea of, yay, wonderful, we're going to get this cut in December. But with this move to 0.3% month over month, that is still the strongest figure that we've had in 7 months. Even if we're going to be getting the cut in December, it's some of that joy sort of tampered out as we say, okay, yes, the numbers are as expected, but this isn't still the all clear that we're getting down to 2% inflation.
It does seem like the all clear for the rally to continue as people look forward and say nothing that we didn't know already, completely in line as expected. We will get those details, as I mentioned, in just a moment with Michael McKee. Joining us now is Jay Bryson of Wells Fargo. Jay, your initial reaction to a hugely surprising print of exactly bang on line what everybody was expecting.
Well, so I'll use a phrase, I'm sure, Danny, you're familiar with this. It's kind of a damp squib, right? I mean, there's nothing to see here. I agree with Mike. And I think the FOMC will go ahead now and cut by 25 basis points next week. It'll be interesting, really, going forward, because we're not at 2% yet. You know, if you take this number and you annualize it, you're at the core number, you're still running at 3.25%. That's still well above where the FOMC wants to see it. Now, tomorrow we'll get PPI, and that'll help us to true up our PCE numbers, which is the more important number for the Fed. But this right here, there's nothing here that would say the Fed doesn't hike or cut rates next week.
Which especially comes after the unemployment rate ticked up just a little bit in the prior NFP that we got last Friday. I just wonder what data is really going to become incredibly important going forward, or essentially if the Fed is going to really open up a blank check to do whatever it wants next year because of the policy uncertainty on the table.
Yeah, so, I mean, the two big numbers are always going to continue to be, at least for the foreseeable future, it's going to continue to be the labor market report and the CPI/PCE sort of numbers. But they will look at the totality of the numbers. We'll get retail spending the day before the FOMC meets. That's still an important number. It's not A-list like those two, but those, I think, will be the real key numbers as we continue to move forward.
First of all, Jay, thank you for using the phrase damp squib. Not enough people say it in this country, and it's perfect for a moment like this. What do you expect then? Now that, we're missing maybe like that tiny piece of the puzzle, but we have labor figures, we have CPI. When it comes to what they project forward for 2025, what are we likely to hear from the Fed? Is this an FOMC that wants to give themselves more optionality to pause at this moment?
Well, so I don't expect Chair Powell in his press conference to be real specific about policy assumptions. I think what will be interesting is when you look at the dot plot for 2025, I think that you're probably going to see a lot of dispersion there depending on what policy assumptions different FOMC members are making. So, if you're a president of a Fed somewhere and you think there's going to be lots of tariffs next year, you're probably going to have a higher dot than otherwise. And so we won't know what those assumptions are. I'm going to assume that during the FOMC meeting, there'll be a robust discussion about that, but we're not going to actually know what they discuss until 5 years from now when the actual transcripts come out.
Right. But putting this all together, what's your base case for 2025? It feels like with this inflation data, basically, the Fed's given this green light to cut next week. Mm-hmm. But what about for 2025?
So what we're assuming is what we've baked into our forecast is not the whole 10% across the board tariff, 60% on China. We've kind of taken half of that, and we've said, okay, we think it's probably going to come maybe in the second half of the year. So our base case is in the second half of next year, you see a big slowdown in the U.S. economy because of these tariffs draining purchasing power, and then inflation coming up. And so, we have the Fed stopping in the summer of next year with their rate cuts.
And that means that the terminal rate is
3.5 to 4, somewhere in that sort of vicinity.
So it'll be interesting to see whether they actually do revise their statement of economic projections next week. Jay Bryson of Wells Fargo, thank you. Wonderful to see you in person. Michael McKee has been parsing through the details of that CPI report. Mike, what do you see?
Well, let's start with the overall CPI because everybody's looking at the 3-digit number to see how strong it was. And in November, 0.313, up from 0.244 the month before. So that tells you we had a little bit extra strength on a 3-digit number. Now, in terms of where we saw the gains, it was in used cars, the second straight month, up 2%. The owner's equivalent rent up 0.2%. That's only half of what we saw last month, and that's the lowest in quite some time. I haven't got a historical for you yet, but it does suggest to the Fed that maybe we are making a little progress there. Our rent of shelter up 0.3. That's down from 0.4 the month before. So a little progress on the side of inflation in housing, which is going to be good news. And then the one thing I wanted to point out here that the incoming president, Donald Trump, suggested he was elected because of the price of eggs. People don't like the price of eggs going up, and they went up a lot, up 8.2% after a 6.4% decline last month. So he can get to work on that.
Michael McKee, thank you so much on the price of eggs. Joining us now on everything else, David Kelly of J.P. Morgan with a reaction to what we just got, basically bang in line with expectations. I imagine you're going to sort of talk about how this is exactly as expected, the disinflationary trend intact. What's your take?
Well, I think it's pretty interesting because when you dig into the data, what we have is rich American inflation. We've got poor world deflation. So if you actually look at where did we see inflation in November? We saw another 0.4 in airline fares. We saw another 0.5 on hotel rates. We saw another 0.6 in new vehicle prices. So the stuff that the rich buy because they've got money is going up. But if you look at energy in recent months has come down a lot. And then, as Michael was pointing out, two of the things that have been holding inflation up, which are shelter costs and auto insurance, were both very mild in this report. So what that tells me is, barring some shock, the CPI numbers will trend down next year. And the next few months are going to show some high year-over-year numbers. But by next spring, I think we're going to be below 2% in year-over-year CPI. But it's really going to be because of a lot of ordinary goods and services bought by ordinary people seeing some deflation pressure, even while things that the playthings and play activities of the rich get more expensive.
We are seeing right now two-year yields take a leg lower as people look through this and get on board with what you're talking about, David, in terms of inflation coming in. How do you dismiss this idea that some of the drivers of inflation, I'm thinking about airplane costs, I'm thinking of cars, I'm thinking about other sectors, are likely starting to see another revival of inflation? How do you discount some of those anecdotes at a time where the cycle has been so confusing?
Yeah, I don't think that's likely to happen barring some policy change. Well, what I focus on a lot is things like labor costs, and we see no evidence that American workers are getting the kinds of wage increases which would ultimately generate inflation from below. So I don't think that's what's going to happen. But I do think that when the Federal Reserve looks at it, they're going to have to look with one eye on what's really going on in the economy right now and one eye on what might be coming in terms of policy going forward. So I do expect that the dot plot next week will be a little bit more cautious than the one in September. I think they'll try and take some rate cuts off the table here in the out years, even though I expect they'll cut in December. So right now, I'd say the inflation story is still benign. It's cooling very slowly, but it's still cooling. But the question is, what are we going to do to that when we attack this with policy changes next year?
And of course, David, the Fed is not political. But how do they avoid a potential political firestorm if they start to take cuts off the table for 2025 in what will be the first year of Trump's second term as president? That seems like something that would absolutely invoke a Truth Social, a tweet, a post, or whatever you call it on X now.
Well, I think they should try and sneak it into the summary of economic projections right now, rather than disappoint with not cutting rates when people expect them to next year. And so I think we'll see a bit of that. I don't think, I think that they won't assume, as Jay Powell has pointed out, they don't speculate, they don't assume, they don't guess. They're not going to assume the impact of all of the potential immigration and tariff policies or indeed fiscal stimulus in 2026 on inflation. They won't assume that. But I think that the individual bank presidents will probably take a rate cut or two off the table for 2025, 2026 and put in the summary of economic projections and see if, because the danger of a big political firestorm over a dot plot when people, when Americans really aren't paying that much attention to the dot plot, I don't think there's that great a danger. I think it's better for them to set up expectations for less easing going forward. Set that up now so they don't have to defend not cutting when people expected them to in the middle of next year.
In the meantime, there's just been this huge surge in optimism as all these soft surveys really follow the politics pretty clearly. There's ones from CEOs from the Business Roundtable saying that they plan to spend more on CapEx, they plan to hire more. Small business optimism is off the charts too. David, at what point does that go from soft data to hard data? Is there a potential for some of that to act as an inflationary force?
I don't think so, but I mean, there is. I think people are happy to have the election behind us. I think there is optimism on deregulation, but I think there is also a fair amount of concern about, how far we're going to push things in terms of tariffs or in terms of deportations. And I think so. I think there's a little bit of caution still out there, and I don't think that the amount of spending that's going to go into the economy is in 2025 is going to cause more inflation, particularly because we've now got a stronger dollar, which is going to reduce import prices. We've got weak global oil prices. We've got a kind of mediocre global economy. So there's nothing external that's generating inflation. I don't see wages in the US generating internal inflation. So right now, I think we're still on it's a very good track. It's steady growth, a little bit above trend growth, with inflation gradually easing down. And this is a really good economy for financial markets. The question is, can we sustain it in 2025?
Could stricter immigration flows, though, could that be a cause for potentially higher wages and wage inflation?
Oh, yes. Yeah, I mean, if we do mass deportations of people who are currently working, whether they're illegal or not, if they're currently working and we deport them, the problem is the native-born working age population in the United States is declining. So if we slam the door on both legal and illegal immigration, then we'll have a problem. But I really don't think that's what's going to happen. I think we'll have to see how it plays out. I think we will see some greater deportation, but I think American business is very anxious that we continue to have skilled workers from around the world come to the United States and help our economy grow. And I think that probably will be sustained.
David Kelly of JP Morgan, thank you as always for your insights. While we have been focusing on CPI, we did get these headlines that Albertsons is terminating its merger pact with Kroger after losing that court case from a judge. Also suing Kroger for gumming up the works, ignoring regulators' concerns, and basically seeking billions of dollars in damages in addition to the immediate $600 million fee, Emery.
Yeah, so the saga continues. I mean, this is the fact that the deal, we know the judge is saying cannot go through, a nice parting gift to the FTC's Lena Khan, but now Albertson is saying that Kroger refused to offer an adequate divestiture package, and they're suing them.
I think that's really interesting because that's actually the exact point that many analysts raised about this deal, saying that this is a problem because Kroger essentially said that they would sell off some of their stores to C&S Wholesale. People at the time said, this is a grocery chain that doesn't have the strategy to make itself a competitor on the lines with the new Kroger and Albertson. And not only that they didn't divest the stores where there were overlaps. They basically did some picking and choosing, saying, maybe we don't like this store. This is one you can have. So this is actually something that a lot of people raised at the time, saying maybe if they had done this and they'd done a better divestiture type structure, they could have got this through. I'm not quite certain whether that's true or not, given the shape of this FTC, but it had been a concern, and Albertson is grabbing onto that.
There is also a feeling that maybe some of the companies that have tried to get involved with some of this M&A that have gotten stymied under Lena Khan are not going to try again so quickly, that some of the animosity and the institutional trauma when it comes to the scars and the costs isn't really worth it for them to pick it up.
Yeah, a lot of executives might say, I actually want to see others go at it first and see what kind of FTC we're dealing with I'm just thinking, how much have lawyers made with this FTC on all these deals just collapsing?
Yeah, well, although they are missing out on those deals that just didn't happen. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Hi, Yahira.
Hi, Lisa. Just to reiterate that news, grocery chain Albertsons has filed a lawsuit against Kroger for breaching its merger agreement. Albertsons claims Kroger refused to offer an adequate divestiture package and ignored regulators' concerns. The company will seek billions of dollars in damages. It comes just after Albertsons said they will terminate the agreement. Yesterday, a federal judge blocked the deal to combine the grocery chains. Meanwhile, ExxonMobil will raise its capital spending next year as it adds its $60 billion purchase of Pioneer to its oil production plans. The company's growth plan is in contrast to its peers like Chevron, which are reducing spending and prioritizing profits over production. Exxon expects to pump 5.4 million barrels of oil per day by 2030, the most in its modern history, despite forecasts of a crude glut next year. And General Motors shares rising in the pre-market, up 1.8% after the company said it plans to shut down its Cruise robo-taxi program, citing high development costs and reputational risks. GM had invested more than $9 billion in Cruise, and at one point it rivaled Google parent Alphabet's Waymo for robo-taxi supremacy in San Francisco and other cities. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Thank you for today. Up next, setting you up for the day ahead, as well as a discussion on old technologies and some new ones. This is Bloomberg Surveillance. So it was the biggest moment until it wasn't, and then it was exactly bang in line, and CPI came and went, and will be forgotten. Counting down to the opening bell, here is the trading diary for the week ahead. Later today, Adobe earnings plus a $39 billion auction of U.S. 10-year notes. Tomorrow, an ECB rate decision. Watch this space, as well as U.S. PPI and another round of jobless claims on Monday. S&P Global PMIs, Tuesday U.S. retail sales. Wednesday really is the main event. That is the Fed rate decision and that statement of economic projections. And coming up tonight on television, peer-to-peer conversations with David Rubenstein. David sat down with Carla Hayden, a Librarian of Congress. And I have to say, David, it's really interesting to see you bookend the old technologies of reading and books and some of the new technologies and some of your more recent conversations also that are coming up. So I want to start with kind of how you frame this conversation and what the librarian had to say.
The Librarian of Congress is appointed by the President of the United States. Carla Hayden was appointed by President Obama and confirmed by the Senate. She is actually unusual in that she's a librarian. There have been 14 librarians of Congress. She's one of the first who's actually a librarian. She's also the first woman to be librarian of Congress and the first African American to be librarian of Congress. She served 22 years as the chief librarian in Baltimore and for a number of years in Chicago as well, where she came to know the Obamas. And what she's now doing is making the Library of Congress available and open to not just scholars, but to every citizen that wants to go there and use the facilities. So she's really transforming the place, but also she's digitizing all of the holdings. They have about 175 million different pieces of books or other kinds of written material, and she's digitizing all these to the extent possible. And so anybody will be able to get access to these through the digital methods.
David, speaking of transformations, you also earlier this week sat down with Dave Ricks, the co-CEO of Eli Lilly, where he told you about this idea that their treatments could be used to treat addictions. How transformative are some of these things going to be in ways that have already reshaped society when it comes to issues like diabetes and obesity?
So for those who aren't familiar, and maybe they've been under a rock, but their world has been transformed by these anti-obesity drugs, which initially started out as drugs to help you with other diseases, for example, diabetes. But now they're really used much more for anti-obesity. And in the case of Eli Lilly, its stock has gone up under Dave Ricks as CEO by about 1,000% since he's been the CEO, the market capitalization up 800%. It's a staggering success story. It's now the most valuable pharmaceutical company in the world by far. And their foundation is also probably the largest foundation in the United States by far. And it's incredible what this one drug has done for the health of people, but also for that stock.
David, I want to get your sense. You're sitting in Washington, D.C. What you're hearing from both policymakers and business leaders when it comes to mergers and acquisitions. Yet last night we got from President-elect Trump his new head of the FTC. He announced it's going to be Andrew Ferguson. Very different potentially from Lina Khan, who's very aggressive and challenging M&A. Do you think that we're going to see a groundswell of more merger activity?
Well, hope springs eternal in the business community, of course. Because I think many people in the business community were not happy with the FTC chair. Whether the world will change dramatically, we don't know. There is some concern about tech companies becoming too big within even the Trump constituency. But on the whole, I think business CEOs are probably looking forward to a new regime in Washington.
David Rubenstein of the Carlyle Group, who always is busy considering that he owns the Orioles, that he interviews these top leaders and is tracking the progress and is the founder of Carlyle. Thank you so much for being with us. We always appreciate your time. You can watch David's interview with Carla Hayden, Librarian of Congress, tonight at 9 p.m. And don't miss this. In about an hour and a half, we have 10:30 a.m. this morning. Bloomberg Television has a David Guerra's sit down with U.S. Treasury Secretary Janet Yellen. Do not miss this as she talks about her tenure and what she sees going forward. I have to say, I expected this CPI report to actually change some of the assumptions. It did not. It came in bang in line with expectations. You look at the internals, it doesn't change as people's opinions. So it really raises the specter. And I'm curious your take on this. And Danny, what do you think the Fed is going to do when they talk about the lack of clarity going into 2025?
That's the difficult thing. This CPI figure made it easy for them next week, but not for 2025. And what we've heard so far from the Fed is just giving themselves a whole lot of optionality, saying that, look, inflation is progressing how we want. Maybe we need to see how restrictive we are and how things progress. You're seeing a lot of language that gives them the ability to pause. It'll be interesting to see what the dot plots look like. If you have some of those committee members, even though they're not saying it, preparing for a world where tariffs and tax cuts means that they can't continue to cut.
So the green light basically set for the December meeting, but 2025, potentially, do you see a Fed that's on pause? Or if you do see tax cuts and tariffs become inflationary, do you go back to what we heard from the Peterson Institute for a month that potentially 2025 you can see a hike?
Right now, you see a 97.7% chance being priced into Fed funds futures that there will be a cut next week. What comes after that is anybody's guess. Coming up tomorrow, don't miss this. Mike Collins of PGIM, Anastasia Amoroso of iCapital, Dana Peterson of the Conference Board, and Scott Cronert of Citigroup. Good morning. This was Bloomberg Surveillance.